What's going on, guys? Can everybody hear me loud and clear? All right, can everybody hear me? Awesome. Just wait for everybody to catch up. Loud and clear, though. Just gonna move this. Great. Yeah, so this is actually the syllabus or what we're going to go over for this one. Just going to give everybody a second. A few people probably still coming on. I have my tea, I have my food set up. One moment. Just want to make sure I have the sound preferences open just in case. Okay. Cool. All right, so this is going to be the entries and exits video. And the last two videos, basically we went over risk management, overlooking or looking over the auction. So identifying what type of auctioning environment we were in. I think that was the first one. And then most of the last workshop was on risk management, and the importance of position sizing. Clearly, it's something that you can't just have an arbitrary process for. And now we're going to cover entries and exits. So I have on the screen to my right, I have your YouTube chat. So I just want to say thank you for everybody who is currently here. I know that scheduling is difficult because we're all in different time zones. We have people in South America, we have people in London and New Zealand, and as you can imagine, it's difficult to coordinate a good time for everybody. So I think in the beginning, my intention was that we would just have one or two workshops, but I think what we'll end up doing is just try to schedule these pretty consistently, maybe like once a month or once every few weeks we'll do a workshop. And once we have the basic stuff down, we can more or less poll the group, poll the community, and see what everyone is interested in going over, maybe where anyone thinks that they have current weakness. Okay, talk about different ideas, different approaches, and yeah, we'll try to keep this type of setting going moving forward. Right, so in this one we're going to be talking about entries and exits. Okay, this is not going to be in regards to any particular method of entering, whether or not it's a moving average crossover or divergence or any of those tools that traders will often use, right? Indicators, things that pretty much are just derivatives of price and smooth out the information for us. As you can tell now, my primary focus has been order flow, and order flow is not by any means a trading strategy. It's not a trading system. It's just a more accurate tool or representation of what is going on. So, the moving average is a representation of the average price over a certain period of time, right? So, if your 20 moving average is, if you're on the daily, that's your average price over those last 20 periods. So an RSI is it's the up down of a certain period of candle bars, right? So average price movement up versus down. If you have it on a 12 or 14 setting, all of these indicators are just derivatives of price, and order flow really is an observation of what is going on at certain price levels, right, between buyers and sellers. So as you can imagine, that is what moves the market, right? So for every buyer, there's a seller, right? The market moves on fear to the upside and fear to the downside, and it comes down to you, myself, or everybody else, either lifting the offer or hitting the bid. and whether or not it is a human being at the other end of the computer physically clicking on a mouse, or it is a high frequency, low latency trading mechanism, it's still based around or programmed by a person, right? Based to look for certain conditions. And a lot of the times, things that are high frequency are going to be just looking at certain anomalous behavior in price and volume. So what we're focused on is the main constituents, right, of what we are involved with, which is what is currently trading. So what we're trading right now is Bitcoin. What does it cost, right? How many people are buying it at this level? How many people were buying it at that level? All right, how many traders were interested in it, when it was 6,000 versus 6,500? And we're trying to interpret this information to get an idea of where the auction is going next, right? Where the market is going to rotate to. So I think that order flow is the most true and honest way to look at the market. Rather, it gives you the most clarity, because at that point you're seeing that specifically at certain levels we had interest. All right, specifically at certain levels there was no interest. All right, there's no real need for trying to interpret without any data when you have the data. Okay, and when you have the data, there's no narrative anymore. Okay, it's not, well, sometimes support holds, sometimes it doesn't. Well, there's clearly times you can see when it's beginning to fail, and if you, like myself, want to be ahead of that and want to be able to sometimes short support, okay, or to be able to sometimes buy what is considered resistance, that gives you the opportunity to be early, right? So a lot of trading is based on the premise that, and this is totally correct, this is the proper way to protect yourself, that you should wait for confirmation. So a lot of our trading will involve some type of confirmation, but it doesn't necessarily mean that price has to move, that the opportunity has to escape you before you realize, okay, it's already taking place, right? So I said this before, and this was a great quote. I think it was in Mind Over Markets, which is a Jim Dalton book, or another book he wrote. It's either Mind Over Markets, I'll think of the title. And he talks about the catcher does not wait to see how fast the runner is running to second base before he tries to throw him out, right? So he's not waiting for the guy to be halfway down the bag or halfway down the baseline before he ultimately decides to throw the ball. He's trying to notice the little things that maybe this runner has been doing in the past. All right, he's trying to notice the runner's behavior when he's at the bag. He's not trying to wait until the runner is in the process of moving from first base to second base. Okay, so rather than wait for complete confirmation in the form of price breaking out and being behind you, I'd rather have an idea that that is actually taking place, right? And say that on balance probabilities that when such and such conditions were this way, that it did take place. And if it were wrong, we at least are in a safe enough position where we are hopefully able to cut our losses pretty quickly, and we don't end up losing too much in doing that. So just had to get that out of the way. So we talk a lot about order flow. It's a tool. So a lot of the stuff we go over in this video, right, it's going to be primarily based on, again, the auction process. So supply and demand, right, absorption and auction. So price auctioning up higher, okay, then price auctioning down lower into absorption. And when we use order flow, when we're talking about things like, cumulative volume, delta divergence, I'm going to show you a tick chart that's going to show you, and it was actually shared recently. Excuse me, as I talk, I'm going to be sipping on my tea. So I'm going to show you on a tick chart how you could look at a one tick chart on EXO, and you could see, certain areas where a bar is only printed when 500,000 contracts are traded. So when you have a really small candle bar, right, or when you have a really small candlestick, and you have that setting, you could see that every time this kept printing at a low or at a high, that indicated that there was a ton of absorption or a hidden order. So we're only using these tools, though, in trading support and resistance, in trading supply and demand, to try to get a step ahead of everyone else who is just looking at the candle, the bar chart, or if you use a bar chart or a candlestick, Japanese candlestick chart, or Heikin Ashi, it doesn't really matter. They're just they're basically representing the same thing, unless you have Heikin Ashi, which takes a little bit of a different approach to calculating the high, low, and whether or not a candle is red or green. Yeah, I love this tea. So we always have to be able to answer the same questions, okay? And it's in your best interest to not only be able to answer these questions, but to be able to try to put yourself into the perspective of someone who is currently long or currently short. So when I say that, it's because we want to be able to look at the market and say, where is the market placing fear, right? So if you looked at an options skew, you could probably tell where the market is placing fear, whether or not it was skewed to the put side or to the call side. But in a current pattern, where is the market? Where does a long have fear? Where does a short have fear? Okay, where is the fight that's taking place? A lot of what I'm going to be talking about is it's going to sound like it's broken down in really simple terms, like the fight between buyers and sellers. Okay, a lot of the times in other systems, they really overcomplicate the jargon, and everything has its. There'd be 3 different systems with 5 different words for the same thing. We're talking about a fight. Okay, we're trading futures, we're trading cryptocurrencies, and pretty much for every long there is a short. So that's why the inverted chart works so well, because the energy and the forces are the same, right? So it's not like equities for the most part where there's an argument that there's a positive sum in that transaction. It's a zero-sum game. If you're trading Bitcoin on Bybit, on BitMEX, on Deribit, on Binance, if you are winning, someone else is losing, okay? And it doesn't have to be the same person you bought it from, obviously, but for you to be experiencing a positive outcome, someone is on the opposite and equal end, obviously experiencing a negative outcome, all right? So we need to be able to take into account some type of game theory or some type of understanding of how these participants are feeling at certain levels, okay? So questions that we need to be able to answer first, I'm going to go over each one of these, all right? So who is in control currently, okay, and which way has the market been trying to go? What time frame are we dealing with? So there are times when structure is determined by the daily. So when we're closer to other time frame controllers, so people who are controlling or trading based on the daily, such as when we were close to the most recent swing low that we broke down from, I said on Twitter that was an area that was going to bring everyone into the market because it was a big enough portion of market structure where it had short-term traders, medium-term traders, and long-term traders interested. So what time frame are we dealing with? If you're interested in trading on a 30-minute time frame, you can be within a range that really means nothing on the daily. You could be within the bottom of something that's forming a new leg. You understand that price is fractal, but there are certain points, such on the 5-minute time frame, where eventually, yes, the 5-minute time frame turning does end up affecting the weekly, right? We have to assume that price is certain. It's like a Russian doll, essentially. So the smaller portions make up the larger ones, and this is important, but getting lost in that, there's more weight on the higher time frames, obviously. Okay, so where's the fight? Right, where is the market currently trending or ranging? So the market always moves from trends to new ranges. Okay, even when it is trending, when it pauses, it's going to range. You call it ranging, you call it consolidation. Just consider it a boxed out area where buyers and sellers are beginning to battle it out again. Whether it's profit taking, whether it's resistance or support, it doesn't really make a difference. So where's the fight currently taking place? So in relation to what area of market structure? Okay, where are the trouble areas for longs and shorts? So longs and shorts are going to be what determine market structure. They're going to be what determine support and resistance. Okay, so remember that once you are long, you are a seller at that point. You're no longer a buyer. Okay, even though you have already bought the market, you're no longer a buyer. You're a seller. So being that you're carrying that weight of already being a seller, you're inheriting being a seller. Okay, your responses to the market movement are going to be dictated based largely in part on fear, right? So fear, if the market is moving against you, okay, we always have this need. There's a survival mechanism to protect ourselves. So a lot of market movement is going to come down to this, right? Come down to human behavior, come down to these survival mechanisms that have been built in place. And I'm not trying to get all like woo-woo on you and turn this into like some nonsense. That's just the way it is, okay? When you put on a large position and you feel really funny inside, that's because your body is saying this is a bad idea. Your decision process is going to change. When you're, off sides, you are not going to be thinking anymore about, say you put on a position and you're off sides, okay, you're immediately off sides. You're not going to be thinking anymore about the profit target, okay? You're going to be thinking, the first area you're going to be thinking about, again, is at break even. So if we're long on a pullback and too many people got trapped up top longing the breakout, but we're in on the pullback, if they experience fear and they start selling out, okay, because they're below price now currently, then what is the likelihood that whenever we do get close to a break even, that the trade still continues upward? All right, you're going to be thinking, this is uncomfortable, I want to get out. And you're feeling and someone else's feeling, and then all of our feelings in the same position are what create market structure. And then finally, do we want to, after considering all of this information, do we want to buy or sell this market? So let's first talk about who is in control currently, which way the market has been trying to go. And this is going to be pretty fast. We can answer this, right? I've given tools before to give you an idea. Okay, you obviously have market structure, right? And this is just 101 stuff, but again, I just want to hit on everything. So you obviously have market structure, period of higher highs, higher lows. Okay, buyers are controlled, all right? Periods of upward movement, much more impulsive, okay, much more volume behind them. The periods of downward movement, all right, as you can see, volume begins to drop off. This is actually Bybit chart, so let me get off Bybit chart because BitMEX is the mover of the market. So periods of buyers in control, spikes in volume, spikes in volume. Sellers, not as interested in selling, okay, less profit taking, all right. What you're seeing is volume drop off, but you're still seeing this pattern, okay, the clear trend is up, buyers in control, all right, from a market structure standpoint, okay, buyers are clearly in control from level to level, okay, and if we're going to use something as a 20 moving average, okay, 20 moving average on the daily, on the 3-day, start using the 2-day and the 3-day also, okay, it's a different periodicity, but it's very useful because, you know, sometimes the weekly is a little too vague, a little too high for time frame. Sometimes the daily is, you know, it's a little bit, it's not too small because obviously it's a very good time frame to use. But try using the 2-day or the 3-day. It could really help you out sometimes. Okay, because imagine it just gives you that sweet spot between the weekly, between the daily. So again, above the 20 moving average, all right, buyers in control. Short-term sellers are controlled, but this is an uptrend. Okay, so trend is up. What are the rules in an uptrend? Okay, we do not anticipate that pullbacks lead to reversals. We anticipate that pullbacks lead to continuation. All right, so basic psychology behind this move is that obviously buyers are interested, pushing this up. Open interest is chewing on a Brussels sprout, excuse me. Open interest is increasing. Okay, volume is supportive of this move. On the pullback, you have some profit taking, but the pullback does not last long because there are people that are really waiting on the sidelines to get in this ASAP. So you don't see a deep retracement. In all patterns of movement upwards, you start to see further and further retracements, okay, as there becomes less and less buying pressure. So if you could look at the market as some type of structure that you're building up from underneath, all right, you're beginning to lose that structural integrity as you move up. All right, this is something that if you visualize it, it makes a little bit more sense, right? So if we're building a structure, the taller we make it, all right, if we're not building a really firm foundation, and if you want to consider, let's say that TA and FA are your foundation, and we have Bitcoin that is a foundation on TA, well, it doesn't have the FA, it doesn't have the fundamentals yet, and fundamentals might give this thing more of a floor, but instead we don't really have money fundamentals, right? So there are people that obviously can argue this till kingdom come, and they talk about Bitcoin's fundamentals, but there's a reason why it dropped so much, and it's because no one's stepping in to get, you know, be a value investor or growth investor the same way. Like I said, if Apple dropped 20%, people are going to come in off the sidelines just because Apple's at a discount, right? They know Apple's not going out of business tomorrow, but Bitcoin's, you know, importance is based on its price. So we're getting further and further retracements. It's becoming more and more apparent that sellers are in control again. And now we're starting to spend more time below the 20 moving average. So you could use that, all right? That is one of the things that determines the candle color on the Cantor and Clark indicator. So Clark indicator, I have the weekly and the monthlies right now. Okay, what you'll see is that the candles that are red show that sellers are in control. Candles that are green are going to show that buyers are in control. And this is going to be the same on the 4-hour. Okay, it's just going to show it on a different time frame, right? There's obviously going to be more periods within a, you know, if we're looking at daily right here, it was all green, but if you go down to the 4-hour, there'll be periods within this daily that were red as well. So if your system is going to be built around the daily or the 4-hour, something as simple to work off of will be, you know, you look at the daily, the 4-hour, and you're going to be longing or looking to buy when we're above the 20 or we're green, or you're going to be looking to short the market when we're red. Okay, so have a default setting. Okay, that is the default setting. You're going to say, I'm looking for pullbacks to long, or I'm going to be looking for rallies to sell. Okay, and this gets into right where we are currently right now, which is why I said that I'm not interested in longs. Okay, I'm not interested in longs because rallies don't really have as much of a clear target as longs in an uptrend. All right, we know that at any point something could look like a rally, and we could expect that maybe it comes up to say this point, everyone was talking about 8,000. Okay, maybe everyone thought it was going to come up to 8,000, but the selling pressure kicks in, and you could be longing this with expectation that you're buying on a pullback. Okay, say that you were looking at this structure. A lot of people were saying this was extremely bullish structure. Okay, because we had a period of higher lows, higher highs. But as you can see, just look at it as if you're looking at an energy wave, right? Or sort of energy wave. It sounds like Star Wars. So look at it as this is the large wave. This wave is large, but it's starting to compress more, and then this next wave not as impulsive. So it's like an accordion. It's starting to squeeze when it gets towards this top. All right. So keep in mind that the higher time frame trend is now down. So I'm not looking for longs because at any point that long can nuke down. The higher probability is in being with the actual motion of the ocean right now. So don't try to hold back the tide with a broom. Don't try to fade a higher time frame trend like this. Okay, don't try to be a hero and call the bottom. No one cares about catching the bottom. No one really catches the bottom or the top. You only find out that it occurred like a week or 2 weeks after, when it becomes really obvious to everybody. Some people get lucky, but there's no sense in trying to trade based on luck. Okay, just take the trades that have the higher probability setups for you that have been working, and as you progress, you just try to build that skill set. You just try to build the amount of setups that you can play, and then suddenly you're a person who went from being able to use you could use an arrow to now you can use a ton of different weapons in your arsenal to try to hunt in this market. So using something as simple as a moving average to identify who's in control. Okay, using something as simple as market structure. Okay, you could start incorporating other things into this. Whether or not you want to look at higher time frame volumes, for example. Start incorporating TA. The more details you add to whether or not you're going to be longing or selling a market, the more it becomes a bit noisy. People end up feeling like more information helps informing their decision-making process. It actually shows that the more that you have the more that you have that you're looking at, you have this feedback, you have that information, you have such and such. It makes you more confident, but it makes you less effective. So just keep it simple. KISS, keep it simple, stupid. So who is in control? So you should be able to, at any point, be able to determine who is in control. And you could lie to yourself sometimes, but you should just look at things such as major rejections, okay? Clear areas where especially in Bitcoin, there's a lot of romanticization. So I do believe in the long-term value of Bitcoin appreciating. Could be 5 years, could be 3 years, doesn't matter. Okay, still going to trade it and just treat this like an awesome trading vehicle. That's what it's always been. Losing this structure should have been clear that sellers were in control. Okay, you lost a higher time frame structure, you consolidated, you dropped down from it, massively impulsive. This is a dead cat bounce basically. So identifying who is in control. All right, so who is in control currently? Which way has the market been trying to go? So you're not trying to get in the way of the market. Okay, you're not going to try to pick up, as they say, nickels in front of a steamroller or a train. It's just the higher probability trade is you just waiting for the setup in the direction that the energy is traveling. Okay, because the market is going to move easier that way. Because when everyone is confident in an uptrend, you could, sure, if you want to be the guy who fades rallies, fades moves up and shorts the pullbacks, that's fine, but are you going to be able to consistently do that and flip your bias? You might as well have a default setting, because the energy in the air on a move up, all right, is one of euphoria. Okay, it's much easier when everyone is in a great mood for them to buy something that's going straight up like this, and it could go up for a long time. Same can be said in a move down. After this defeat up here, all right, where everyone is sort of crushed for the short term, okay, everyone is going to be a little bit more trigger happy to hit the sell button. Okay, at first sign of weakness, if you think about how you act and how that accumulates across the span of thousands of people, okay, you start getting a little hesitant when price pulls back. Think about what happens, the multiplier of that effect, when you have hundreds and hundreds of traders thinking and feeling the same way. So one thing you have to learn when you go through life is that everyone is the same. We all act the same. We're all sort of predictable. We look slightly different, but we all pretty much act on the same emotions. Some of us are better at, maintaining a certain level of discipline, but it's really difficult to divorce yourself from any type of emotion, to become emotionally dispassionate and calculated and cold. That's why you should try to be as systematic as possible, but it's difficult. So who is in control? Which way the market trying to go? What time frame am I dealing with? Okay, so I talk about other time frame controllants, other time frame participants. So on the higher time frame, on the daily, so this is clearly the uptrend. This is the market structure that is formed. All right, at any time, if we are taking a trade in any of these major areas, okay, we have to be mindful of the larger participants that are also playing, because at these areas, that's when everyone else comes into the market. So when you're a smaller participant, okay, when you are, I'm just going to make these lines so it doesn't look as ugly. So here's market structure. So when you're a smaller participant and you're playing in these areas, you don't have to be too mindful of the higher time frame participants, because they might come in over here to sell again. They might come in down here to buy again. But there's intermediate time frame trend participants, there's short-term trend participants. These are your smaller players. Anytime you approach higher time frame structure, though, you have to be mindful of the larger participants in play. Okay, so if you're on the 5-minute time frame, you don't really have to worry about someone who maybe is trading the weekly or the daily. And the point is that they're not the same trader as you. People who are trading higher time frames, they're more they're more patient. Okay, they're trying to put on larger positions often. They're more likely swing traders, position traders. So you can't really fade them when they're moving. So keep that in mind, right? So what time frame are we dealing on? So anything from the 4-hour up to the daily, okay, if we are not in the midpoint of a range, we have to be mindful of the higher time frame, okay? If you're in the no man's land, then you can trade, the 1-hour, the 4-hour, and not really have to worry too much. But you have to keep in mind the trend, obviously. So we are now in the downtrend, okay? No matter what goes on in the 4-hour, we have to imagine that there is a faster expiration for anything that moves up when the overall trend is down. So when the overall trend is down, any of these moves up, we're not taking them expecting these moves up to be the reversals, okay? Regardless of what you see on Twitter, where everyone is trying to literally call the bottom, it's mind-blowing, but it's not, because you've seen a lot of people who trade crypto, they never saw stock twits. They never run a stock forum on like a small cap or a penny stock. They didn't see the madness that exists. People are absolutely they are just delusional. So people are absolutely delusional, and they will literally trade things that are floored. Okay, and you'll see in these chat rooms, I think there's one called a stock called DPW, or it's a holdings company or shipping company, and it went from like $3 to like 20 cents. And I remember at $3, everyone was talking about the information that was coming out to shoot it up to 10, and then it got down to half. It was at $1.50, and then I think it got down to 20 cents. I could be wrong about the stock ticker, but same thing. At 20 cents, there are people in those rooms. They're just hanging on to an all-time high again. All right, not the same as Bitcoin, not the same structure. Okay, company is completely, it might as well be just boarded up at this point. But nevertheless, you have people that are always they think that it's going to happen, right, in the moment that they're trading it. So when you are participating on a 4-hour in a range down here, you're not going to delude yourself into thinking that this is the next bottom for a new high, okay? Because your first area of business is always the most recent market structure. So always keep things in frame, right? Moving forward, keep things in frame. So is the market currently trending or ranging? Okay, as I said before, the market does go from trends to boxes, ranges, brackets, whatever you want to call them. All right, don't let anyone tell you that saying it wrong is that it means anything. Okay, it's just a period where there's a fight. All right, everyone was happy over here, now they're fighting it out. So to be determined. Now again, same thing, longer fight. Okay, typically what we'll see is that as price moves up impulsively, these fights will become larger because there are more sellers interested at this point of the auction. Okay, so this point of the auction, okay, at this point, there's less people interested in buying up here. This is above value, okay, just like an auction. We're moving prices up, we're selling cattle, we're selling corn, doesn't matter. You get to a point where no one is yelling in the room anymore. So consider again the volume of the room as in the volume of the market. So sellers become more interested. You see more absorption and passive selling up here. But again, we went from trends to ranges. Okay, Bitcoin likes to spend a lot of times in ranges. Okay, I'd say markets mostly range 70% of the time, and then it will blow out into a new trend, and then it'll range and it'll continue this process. There are different types of trends, so keep this in mind too. So always be able to identify what type of market environment you're in, or what type of regime. So for this period, this felt like the beginning of a secular bull trend, or the next part of the secular bull trend. And it very well could be, but it's just not going to happen as everyone expects it to happen. Okay, the market could go down to 2,000. Doesn't make a difference. All right, people are too attached to numbers. So as long as the network is up and running, then there should be nothing really to worry about. Okay, I don't see that Bitcoin dies. I see that people continue to get shocked by it. But nevertheless, this is a period that is different than your trends here, here, downtrend here. This is actually more like these. Okay, so within these periods, okay, this is not a period that the market is going to spend a lot of time in. The market is going to spend more time ranging like this, than anything else. Okay, this type of trend occurs when it is hype driven, when there's a bunch of new participants in the market, and that's when you get one of these exhaustive blow off tops. Okay, so exhaustion, moves that are standard deviations greater than what started down here. We start to see a lot of skipping and liquidity. Okay, so this trend is different than the trends that'll result now until we get another major push. All right, what we'll do is we'll spend a lot of time ranging, and the trends that occur will be, from, let's say, from one box. We go from box to box, and the trends that occur will be small trends between these boxes, okay, until a new major trend is formed, right, by breaking likely the all-time high. So hopefully this stuff is hitting, even though I'm drawing pretty fast. We're not really into it yet, but the point is the market currently trending or ranging, okay? Trend is clearly the series of higher highs, higher lows. This is where moving averages help too, right? Do you need help identifying the trend? Price is above a fast moving average. Pretty obvious we're in a good uptrend. Okay, price is above a slower moving average. Again, 20 moving average useful. Higher time frame moving averages, clearly price is in an uptrend. Okay, when has the trend changed? You can look at a lot of these different tools. Okay, market structure is one of the best. Right, anticipating a trend change, difficult. Timing the market, difficult, not impossible. Right, so anyone who says it's impossible, all right, there are plenty of people that said things are impossible, and there are people that do them every single day. All right, there are people that are at the same poker table consecutively every single year. There are people that, they always have the most home runs in a baseball season, but, the odds are in baseball you're a good hitter if you hit 3 out of 10. So just consider that there are people that are successful at doing things, and what they've done is just spotted these things multiple times over. All right, they've gotten a keen eye for it. So is the market trending or is it ranging? I prefer when the market is in wide ranges, okay? Trends like this, all right, they're violent. They're something that you don't immediately trust because you're waiting for a reversal. So more often than not, they leave a large portion of people behind. And the reason why they continue so fast upward through here is because at this point, this is when everyone came into the market because it's finally good enough for them to join. At that point, that's when the market reverses. But when is the market trending? When is it ranging? Okay, the range, you can identify with this with your eye. Okay, there's no special sauce to this. There are periods where there's a battle between buyers and sellers. Usually you'll put in what looks like a swing low, a swing high, and then you'll have one of these. And this is what? This looks like your PQRST interval. So PQRST, I believe, your sinus rhythm. So it looks like a heartbeat, right? So it starts like this, puts in a high, puts in a low, spends a lot of time doing stuff in between here, okay? But we'll get into all this in a second just to go over this really quickly. All right, so where's the fight currently taking place? This is going to be kind of obvious. You're looking at the range. Where is the fight taking place within the range, okay? And then getting into the more important questions, where are the trouble areas for longs and shorts? Okay, so trouble area, okay, means that if I'm currently long, where am I in trouble, right? So am I in trouble if I long at the top of a breakout? How does that affect the market? If I am in trouble if I am short and price is moving against me, all right? So that's a very important question to be able to answer, not for yourself necessarily, but to consider how other players are positioned, right? So the ways that we find our positioning, if we're not just looking at funding and open interest and premium, something as simple as you get a bunch of people talking about everyone thinks that the market is going to sell off at this place. It's funny how everyone thinks it's an obvious short. So if you see a bunch of people saying everyone thinks that 8,000 is such an obvious short, it can't hold, it's got to nuke through. Well, keep one thing in mind, higher time frame trend is down. 8,000 was the next point of market structure. It was likely going to get front run. And if you see enough people saying everyone thinks that shorts are the obvious play, they're going to get blown out, what does that mean? How do you think that those people are positioned? Okay, those people are probably already long, right? So you could get an idea of what people's positioning is by just what their attitude is and what they're saying, right? And not that Twitter moves the market, but if you have a sample, okay, and you notice a certain level of consistency with behavior and price action on the higher time frame, then you should probably consider it, right? So you get an idea of positioning based on what people say about the other side of the market, okay? So when everyone is confident, this is why it works out. If everyone's confident and you see that the market is not moving up anymore, Well, damn, who's left to buy, right? So if everyone is extremely negative, right? That's why sentiment, buy blood. If everyone is extremely negative, but price is beginning to flatten out, who's left to sell? Who is going to sell in the intermediate time frame at least? So, and then if you're wrong, where would you want to get out? So this is going to largely impact, we're going to be talking about fake outs and how this affects head fakes and so forth, and how it affects, price movements in the opposite direction. Why we get these really violent moves. So, for example, you've all seen, I'm sure, periods where the market is, say, for example, moves up. Okay, there's like a higher time frame resistance over here in the distance. It's coming up to this area, goes above here, and then what suddenly it does is nukes down through here. Okay, head fake up here, and then it comes down here and it doesn't even stop here, right? So why doesn't it stop there? Just to give you some insight into how this works. So say that I am currently, I'm currently a short, for example, right? So if I'm a short, right here, and I'm anticipating this moving down, my targets are likely to buy right here. So when price moves against me, what do I do as a short? I buy and price moves up, What am I doing at the same time that I'm buying, on this fake out, So I'm one participant, I'm a short. I am currently short, price moves against me. When I exit my position, I help price move up. What do I do when I exit my position inadvertently? If I especially have a trigger to close on, I remove any of my targets, which were buys down here. So any resistance that price would have had from those participants alone is taken off. Let's think about how it affects other participants as well. So let's think about, for example, when we are currently, let's redo this whole thing. If we are currently, let's say, just draw this out again, just give you an idea of psychology, right? So if we are currently, for example, we're longing this breakout. So we're longing this breakout, same thing. Even if we're not a short that was captured right here, if we're longing this breakout, all those shorts that are currently, they popped up, so they help this move up, all right, but price moves back down below here. I am long right here, I am now in pain because price is down here, all right. Now that I'm long down here, where do you think I put my stop? I put my stop maybe right here. So we have the stops right here from longs, We have the target placements, all right, for the take profits from shorts right here. So these two forms, this form of buying, all right, that would have moved price back up is gone now, The longs that longed on the breakout here, their form of selling is now here. So this is a terrible drawing, but you get the idea. So the longs right now, all right, let's get back out of there. So currently, price moves up, breaks down below, all right. The take profits that would have been for shorts down here are gone because they've removed, because they've closed out. Your longs that are now underwater right here, their stop loss right here, their stop market order, is currently there as well. So you have all of this fuel now that helps move to the downside. So if you're ever wondering why you get these moves that are extremely violent, where price comes up, consolidates, it peaks, and then what does it do? You see immediately it fills, and then boom, it comes back down. That's because you have all of this occurring in that moment that all those orders are triggered. So you have to think about how the traders are interacting or what actions they're taking, and where they're currently sitting in fear. All right, so let's make sure that we cover the bullet points. And then do I want to buy or sell this market? So that is after you've decided, after you've answered these questions, and clearly, you're not going to be able to answer all these questions immediately, right? You're going to have to do some careful observation, And then at one point this becomes, like if I tried to tell you how to tie your shoes without showing you as a kid, you would have no idea. If I just verbally gave you information on how to tie your shoes, you'd have no idea what you're doing. Oh, take this, you would be lost after me saying, take the other lace and then wrap it like this. You just have no idea. So you only know how to do this after you've done it multiple times. So then do I want to buy or sell this market? So before we look at a chart, again, let's go over the dynamic that occurs at support and resistance. So what do we have right here? We are long from here. We're long down here. All right, so what just happened to my line? Let's do that again. So longs down here. Take profits are up here. So selling pressure up here. Shorts up here. So shorts, longs. Shorts up here looking to take advantage of that. Okay, that is what causes this rotation. Longs, shorts, longs, balance, right? This is the rotation that you should be looking at price doing, right? So when you're looking at something like an XO chart, so if we're saying we're looking at this, imagine price doing this. So coming down, going up, down, down. Think about it as a wave traveling through here, all right? Think about the rotations through the actual chart. So at support, it's actually easier if I look at this on this. So at, let's say, for example, let's say within a range, right over here. See if I get this line to work. There we go. I'm trying to get used to using my speed buttons. So at resistance, what do we have? Okay, we have shorts looking to open up. We have longs looking to take profit. So that's two forms of selling pressure. If you're long, you're a seller of the market. Okay, so as price moves up, we have that form down here. Okay, as price moves back down in this rotation, so from one rotation, okay, I'd love it if it selected this drawing tool. So one rotation up, okay, back down. What happens? Shorts take profit down here. Longs are re-entering into the market. So you have this balance, okay? Now what happens when you come out of balance though? So let's say that I'm currently trying to short this market, okay, right here. So I wish I had boxes set up so I could show you an idea of what is long and short, but I'm sure from my dictation alone you'll remember. So I'm short this market, but it comes above here, okay? So it comes above here, and what am I? All right, I'm currently underwater. What do I want to do at that point? I want to get back to break even. Okay, so a lot of the times when price breaks above an area, okay, like this, if I'm currently short, okay, so if I am short from here, okay, but price comes back above here, all right, I'm currently underwater, right? So what am I going to do, and why does this end up fueling breakout trades? All right, so when there's enough shorts up here that are underwater when price comes up here, what are they looking to do at this point? They're not looking to buy down here. Okay, the first area of business they're concerned with now is over here. Okay, so this is why retests get fueled by shorts as well. Because when price comes down here, the fear, okay, and the emotion of wanting to get out at that point is stronger than the idea of this actually closing back within here. So when price comes back down here, what do? They cover. Buyers are looking to buy at this retest. We have movement upward. All right. When price comes down low, all right, for example, let's say that we have a short that shorts on the breakdown, okay, but again, this is a head fake. Comes back above, okay, currently, what does a short want to do whenever price comes back down to this area? Okay, price, rather, a short wants to currently get out of this position. Okay, it reclaims this area, a short wants to get out. What are they at this point? They're a buyer. So this is the dynamic that you have to think of that occurs in rotations. Okay, so look at the market as if it is a series of rotations between which these buyers and sellers are having to make these decisions based on fear, largely in part. Okay, so when I have, say for example, a long that I'm currently long, all right, bouncing, price comes down here. Okay, I'm looking to long here, all right, looking to long here. Price kind of skips through this level. Where's my stop likely? My stop is likely right here. Okay, if I'm a breakout short trader at this point, if I'm looking to take the short trade, I'm adding fuel to this. So this is why identifying positioning and where the market might be crowded can be extremely useful. When you see that the market is either really crowded or really long, and we are approaching a pain point, so pain points being when you are long. So if I'm currently, I just want to make this drawing tool less obnoxious. I don't like thick drawing lines. So if I am, come on, you could do it. Okay, if I am currently long right here, or right here rather, okay, I don't like that, that's ugly. Let me stick with boxes. So if I'm currently long right here, where am I in pain? I am in pain all below here. So this center line that we talk about, okay, the center line, you could use a volume point of control. This is the area where when I am long, I'm currently in pain, okay? So at this point, I become selling pressure below here, all right? Selling pressure to fuel any move to the downside, okay? So any point when I am long up here, anticipating a breakout, I make this much more possible, all right? I make this major breakdown much more possible if price begins to meander down here. So when you're looking at a range, okay, and we're looking at this point, for example, and we got to say, all right, where do I want to buy and sell this market? Well, identifying first, importantly, what the higher time frame trend is, right? So clearly the higher time frame trend at this point has been down. So we came into this box here, rotation, rotation, okay, rotation. Now we are spending a majority of the time down here. Now we've deflected off of this midline. Okay, so clearly, okay, at this point the sellers are in control. Now all of these longs up here, do you think that they're confident at this point? No, they're likely just willing to get out of this trade at anything that is relatively close to here. So you have to think about the psychology of the other participants, all right? And one thing that other people don't talk about enough is where these traders are taking away their orders that used to be support. So if you were short, all right, and price came up here, and you're looking for this short, but price skirted through here, okay? If we get that fake out and price comes down here now, obviously your order is gone. Okay, your take profit order is gone, and there are still those buy stops that are down here. So that's why you get these violent moves that occur really swiftly, where you have one of these, you have one of these lightsabers, for example. So let me find one. So say, for example, we're looking at, where was it? It was the other night. Okay, so we had this break. This is perfect. So let's highlight this box. Okay, so this is your small little range above here that looked like it was potentially a breakout of this zone, but you can see a ton of wicks going up into this, ton of absorption. All right, so if I'm currently at this point trying to short this market, all right, when this market breaks up, I'm probably not interested in shorting anymore because we're breaking above this high. All right, my take profit might have been right at this high, it might have been at this low, but I'm likely removing it at that point. All right, so I'm likely removing my take profit. So when I remove my take profit, I'm removing buy pressure because I'm short. So if I'm short, I'm a buyer. Okay, so I'm removing any of the buy pressure or the resistance that would have kept price up over here. So this is why you have to think about the traders that are thrown off, because it's not just the traders that are in position that have to sell, it's the traders that are in position that might have been correct but were faked out. So when price came above here and a short closed out because they were worried and they wanted to get out at break even, their stop or their take profit is off down here. So there's no resistance anymore. And the short, or rather the long, that got in on this breakout, okay, anticipating this high breaking, okay, that guy who had that market buy, all right, his stop is probably right here. So all of this downward pressure. So you have to be able to at any point identify where the market is likely crowded, okay, where the market is likely to experience fear, and if you are going to be long, okay, if I'm long, I have to think about, okay, if I'm long, where do I want to get out? Okay, so if I'm currently short a market, where would I want to get out? Okay, because that's the area that price is likely going to swiftly move through. So with all of these things in consideration, okay, I'm going to take a 2-minute break, and then we're going to get into actually looking at setups. All right, so we're going to get into the way that, so for example, when we talk about backside setup, I'll show you an example before I use the bathroom for 5 seconds. So we talk about backside entry, right? So here's the backside entry from the other night. So here is a point in which the market is ranging, right? So we have a range high. Okay, this is pretty high up here. It goes all the way up here. So we'll just include the whole fight. Okay, so the whole fight occurs within here. Okay, so market came up through here, created a high. Okay, if we put on, let's see, not that. One sec. Put on this indicator, fixed range. Okay, now we'll highlight the value area high, value area low. Okay, so what do we see? The market came up here, created an exhaustive high up here. All right. Likely would be, at this point up here, a lot of buy stops placed. Okay, traders looking to buy on a breakout of this. Okay, traders looking to short this as well. Price rotates through here. Okay, redo that drawing because that's not good for art. Doesn't matter, whatever. Comes through here. Okay, spending a good amount of time above the point of control. Looks bullish. The final move up, okay, ultimately is rejected violently, and the backside move entry we were talking about, okay, occurred right here. So this is your backside entry. All right, your stop would be placed up here, and now this is for a short. But we're talking about a market that is primarily governed by the futures market. All right, it's primarily governed by BitMEX. Okay, it is a zero-sum game. Every short is a long. Whether you're trading Binance futures, whether you're trading Bitcoin on Deribit, it doesn't matter. Okay, so this chart is always going to look the same in the opposite direction. So look at this long setup now. So in this setup, we're longing, but it's actually a short because it's an inverted chart. So price came above here, rejected on the breakout. So this looked like a breakout, right? So price comes above, in this case it was breaking down, comes above, triggers these buy stops, all right? But selling pressure overwhelms them. At that point, their stops are right down here, okay? At that point, any short that had to close out right here, okay, they've removed their take profit. Price swiftly comes down here and forms this range, all right? This range is consolidating. It forms this low, okay? That's our lower bounds. This is the upper bounds of the auction. And then what we have is, this is essentially the front side, okay, but it's the inverted backside entry of this range. Okay, so keep this in mind before we get on to the rest of this video, but I have to use the bathroom real quick. So give me about 2 minutes. Okay guys, back. So I just want to look at if anyone has any questions before we get into identifying solid entries, okay, entering in ranges, entering in high probability entries for ranges or exits. You know, if you consider the short an entry and a long, if it was an inverted chart, it's funny how the charts will look identical on the way up and on the way down. All right, it's not, sometimes it's not just your brain tricking you. It's just that's all it is. It's for every buyer there's a seller, and they're acting based on fear, because sellers, the market moves upwards in commodities because of sellers' fear, right? Because they act in fear when they close out. In equities, fear ends up creating violent moves downward. So does anyone have any questions? All right, so yeah, 3-to-1 odds Ryan chokes on a Brussels sprout. I forgot to eat my Brussels sprouts. I'm eating Brussels sprouts and corn and carrots and garlic because I'm still sick. So I crushed up a few cloves of garlic, turmeric, black pepper, and I'm trying to nurse myself back. So let me just make sure my volume's on. Everyone hear me? Yeah, everyone hears me. Okay. So does that mean that we should consider the BitMEX market as we trade on Bybit? Yes. I look at BitMEX's chart. Okay. I look at BitMEX's chart because it has the most volume and it moves the market. All right. You'll notice that during periods of retail frenzy, that the spot markets will exceed the derivatives market, right? Temporarily as people pour in, but we haven't seen that in a while, where there's a premium, where there's a discount between spot and futures, right? Where the spot is trading at a premium to the futures. So This is not something you often see. Most of the trading is done on BitMEX, the larger traders, the larger position sizes, even though they're notional. So there, with the leverage that is used, even though futures should smooth out a market and make it less volatile, it's not a normal market where it's healthy amounts of leverage used and there's volatility suppression. It creates more volatility because there's traders with small amount of money, large amount of leverage, and when they get liquidated, it causes these really violent moves. And being that the most volume is on that exchange, it kind of dictates the movement of the market or the short-term and intermediate-term trend. In the below drawing, I don't know, I can't see a link that you put. I can't click on that. So you have to put that on Blockroutes, and I'll definitely be able to give you a detailed response on Blockroutes. So any other questions from anybody? I'm going to take another bite of my Brussels sprouts. I'm going to see if I can see that link on something else. No, I can't. Deviations would be like, you could consider that, if you want to talk about deviation, go on to right time frame. You could consider this a deviation, you could consider this a deviation, just outside of the range before collapsing back into the range. So, okay, first things first. You're welcome. All right, so at any point, we are looking at the market in a higher time frame view first, okay, because the weekly points are absolutely important. So the first thing I do, but regardless of what type of trading style you're using, what type of system you have, right, your system is largely going to be on position sizing and risk management, but the first thing I absolutely do is I highlight the major swing points on the weekly, and I always just leave these on. The only time I wiped my chart clean was most recently after we dumped through all of them, because the most relevant one now is the one we're below, right? So I had all these levels marked up here. I feel like I could repaint the chart now, because as the chart evolves, those levels are going to become, we'll see what levels still maintain their importance and what levels are pretty much unimportant at this point moving forward. So I include the bodies and the wicks, right? So I mentioned plenty of times where the wicks are going to be very important areas, right? So highs, lows of the bodies. Okay, it might seem like a lot of lines, but that's what it is, right? These are the weeklies. So there's where a good degree of confluence is between the weekly closes and opens. So if you want, you could put on the Clark indicator, and you can see these immediately. So if I put on the Clark indicator, you'll notice how the weeklies right now are not really obvious because we're on the weekly. If it went down to the daily, you'd see that the weeklies line up with the lines that I drew, the weeklies being the black lines. So that is where there's a weekly swing high or weekly swing low. So taking this indicator off, okay, so we have to have these marked, okay, because this is going to basically include all of the major market structures. So swing high, swing low, okay, low point of this structure. Clearly this is going to be the high point that's important. All right, these wicks are important as well because all of this, there was a lot that went on up here. That's why charts or wicks are sometimes deceiving, because if you don't understand that this is just a period setting that includes all of the other important periods and a lot went on there, you can really overlook this, right? So a lot of the time traders they'll create trend lines, they'll only include wicks, they'll only include candle bodies. Well, why not include the areas where buyers and sellers are most interested, where there is more of a fight, okay? Sometimes it's in a wick in one candle, sometimes it's in a body in another. So that's why I use EXO charts as well. That's why I use Sierra charts originally, all right? And when I'm looking at footprint charts, okay, I'm looking at footprint charts to find imbalances, okay, to find where there is reactive versus initiative behavior on part of buyers and sellers, and to identify those divergences, okay, between passive order flow and active order flow. So marking up the weeklies first, swing high, swing low, okay, now this low point over here. All right, so it's going to look like a lot of lines right now because we're on the higher time frame chart. Now we'll go down to the daily, okay, and we can see how this encapsulates these certain important areas that were pivotal points, rather. So this was your support, it lines up loosely, right? So loosely down here, wicks, body, wicks, okay. But again, why is this important? Well, this is important. We could place some confidence in placing trades around this area because your algorithms that are programmed, okay, whether or not it's a bot created by a large trader, whether or not it's a hedge fund that's buying based on a monthly open, whether or not it's based on these things are important because there are certain programmed, automatically traded, whether you call it whether it's algorithmically, or in this case it's not really an algorithm because it's pretty simple. You know, it's simple input of, okay, this is a weekly important structure, we're going to be buying here. Okay, we're going to be supporting here for a higher time frame trader. These areas you're going to see are going to be important. All right, moving forward. Okay, eyes on, if your eye can spot it on the chart, if your eye is drawn to it immediately, circle it, mark it off on your chart. Okay, and then more often than not, you have people that can't figure out whether or not they should include the wick or precise line. And what I would say is just use a box to keep the wick and the body. Okay, box for the wicks and the body. And I don't want too much noise on my chart, so I'll leave the box semi-transparent. So for down here, okay, normally my lines would be more transparent, but you get the idea. It's now, if I go under the 4 hour, I can see when I'm approaching those important zones. All right. So first I'm marking up my chart. So I'm identifying these major areas. Now in the lower time frame, we talked about how these areas evolve, and you can see that moving forward, you know, they will interact with the weekly and the monthly and these higher time frame areas, daily swings, highs, lows, you get it. But it will evolve over time, so you'll see that it will interact with these, all right, loosely, again, but you're not going to really know, okay, is this a precise point to enter? Do I stagger some limit orders here? Do I stagger my exits here? That's a case to be made whether or not you're going to be using limit or market. All right, there are, as many would have you believe, market orders are not good to use, but that's actually not true. So it depends on a few things, right? Sometimes you just can't use a limit order because you don't have time. You don't have the luxury of waiting for price to come back to you, okay? Sometimes you need to catch it like a net where you use a bunch of limit orders. So you have these areas marked, and then, yeah, you'll see that over time, as I said before, you go down to, if you go down to a 15-minute, if you go down to a 30-minute or an hour, you'll see that you could find more specific areas where, you know, it's a little bit more confluence moving forward, right? So we have to imagine that these weekly areas back here, they're very important moving forward, but as we get into more recent price action, we'll see that, okay, maybe it's not so much right here anymore, but it is that, you know, say for example, there's not a perfect example on this chart right here, but let's just say that we'll circle this is clearly an important area, right? So this is an area that has been evolved, right? So it has evolved through time. This is an important area on the shorter and intermediate time frame. Now, as I said, always keep in mind the time frame. So what area is going to be more important? Okay, what area think is going to have more weight? Which area is going to, do you think, be able to sustain any type of movement? Well, it's going to be the higher time frame area. So we're not going to look at this area to fade the higher time frame trend. But this is an area that we can look at when we're looking for a specific entry. So what I do is observe the chart from a higher time frame down to lower time frame, from the weekly to the day. Then I'll look at the structure on the 4 hour to get an idea more clearly, and then my entry I'm going to probably spot on the 15 to 30. So some people say that they only trade the weekly or the day or the 4 hour, but they're likely going to be spotting their entry on the 15 or the 30. So on the short that I had this morning, what did I do? I spotted this right here. I was actually, you could see it on the 5, you could see it on the 15, but this was the pullback right here to this small consolidation point. Okay, I was getting in based on higher time frame market structure, okay, but my entry, I went down with a scalpel, okay, because I wanted to see, okay, rejected multiple times, looking at the price action here. This is where, so when you're trading, you're not going to be, a lot of you have maybe multiple screens, okay? If you don't have multiple screens, that's fine. What you're going to be doing is you're going to have your trading view chart marked out, okay? You're going to have your trading interface, so if you're on Bybit, if you're on BitMEX, if you're on Deribit, and then I'll have my EXO charts, and that is where I'm going level to level. So I am, when I'm looking to enter, when I'm looking to fade, this is where I take out the chart and I say, for example, all right, I'm looking at this area. I have this area isolated. Now I am going onto EXO charts. I want to see how price is behaving moving up into this area. Okay, so when we move up into this area, so let's look over here. Okay, how did price behave? Okay, so I'm just making sure this is the same area. This was, yes. Okay, so I'm on the 15-minute on the other, so let's go to the 15. All right. Okay, so moving up, okay, strong price action. You can see volume is supportive, all right, but then we have a heavy rejection over here. And not only do we have a heavy rejection, we have a rejection over here as a clear pin bar, right? So the problem is when you have imbalances at the top of these boxes. So imbalances at the top, what do they mean? Okay, so imbalance meaning if you're on Tensor or if you're on XO, these highlighted numbers if you have the imbalance chosen. Okay, so highlighted meaning people got aggressively long up here. So buyers bought the top. So what does this look like? Okay, so now I know that up here, that if I was just a price action trader, I'm looking at this and I'm thinking, well, that's a rejection, but you know, this is a rejection too. This ended up moving further upward. This looked like a rejection also. So did this one. But here, I not only see a really tight pin bar like that, but I see there's a major imbalance up here. So 2.5 million contracts bought between this level compared to 467,000, okay, sold at this level. So volume at the bid, volume at the offer, buying volume right here, okay? So what this looks like is that traders got aggressively long up here. Okay, so what does that mean? Okay, that this pin bar now I could start thinking about the other traders in the market. So if I just bought 2.5 million contracts, and not meaning that came from one trader, but if that comes from a few, then what does that mean? Price moves back down here. Now once price is below this area, okay, so when it's below here, so I'm going to get down to the 1 minute to show you. I don't say to go on the 1 minute, but this is how I'll be able to show you what it looks like when it's really broken down. So multiple rejections. Okay, so right here, multiple rejections. Okay, and you can see that on the lower time frame how the market structure changes. Okay, why am I still making lines? Okay, there you go. Okay, so high, rejection, rejection again, fall below. And if you were just looking at this as a series of higher highs and higher lows, okay, now we are starting to make a lower low. This is your backside right here, okay? So what you see is traders are trapped up here in this bar, okay? A ton of volume in this candle right here. Now we have, not only do we have aggressive buying right here, we have initiative buying or initiative selling right here. So initiative meaning traders are aggressively selling. So aggressive imbalance after this rejection, all right? Another aggressive imbalance right here. Another aggressive. So firm rejection right here, okay? Firm rejection. A lot of volume up here. Value area above the candlestick. So now I'm looking at my chart. I see that, and what do I know about this area? Ton of trap traders right here, okay? Their stops are likely down here, okay? They're likely based on market structure. So did they give some price room to breathe? They probably did. That's why you had this skipping down here. So now I know there are trap traders, and the pressure is on them. So the selling is already built into price at this point, all right? What else do I know? I also know that the higher time frame trend is dire. So there's a lot of things that I'm thinking of. And I'm thinking that if I'm long, I'm not confident. So I'm certainly not going to hold on to position because I know that we came up here and we were rejected. Okay, we came up here and we were rejected. What's the odds that we don't just come up here and nuke all the way down? So these are all the things I'd be thinking of. So for me, I entered in short. I entered in short because I'm playing on the fear of other traders. Okay, it says that my video is not receiving enough information, so it might be buffering, so I'm just going to wait a second, make sure that I have everyone still here. Okay, I'm just going to wait. Can everyone still hear me? Capitals? I don't know why. One sec. Maybe a second lag. We'll take a second. Stream health. Okay, so this is how I'm using the order flow chart or the footprint chart. Okay, I want to see that there are potentially trap traders. Okay, I want to see clear rejection. All right, remember, if this is an auction, all right, and price is coming up to the top of the area, so after there's a rotation down, so we're looking at a rotation, all right, rotation down, price is coming back up to test this previous auction area, all right, to try to get back into this area. What don't we want to see as price comes back down? We don't, as price comes up, okay? We don't want to see initiative selling. We don't want to see a major rejection. Okay, so we have that, and then we have initiative selling. So this is a clear opportunity to get short, okay? Delta negative, delta increasingly negative. This is what you're going to be doing when you're looking at the chart like this, okay? So I'm looking at levels, and then I'm looking at potential divergences in delta. So if we go on to, say for example, we're on the 15-minute and we're trying to spot our entry, and I haven't got into actually mapping this out yet. So where do we start to see a lot of weakness? Okay, you could start to see a lot of weakness when you see, for example, before even that occurred, so as price is moving upward, it's already having trouble. So you see that over here, positive delta, okay, so positive delta, red candle. So large amount of volume up here again, but price closes back below the value area and the delta is positive. So this is an outright divergence within this single rotation right here. So you could go on to, you could go on to the 1 hour, you could spot these, you could go on to the 4 hour. Same case can be made. So again, where you have cases like initiative selling over here at the top of a range, okay, green candle, rejected down, volume above, heavy selling. Okay, you see this at the tops when there are red candles with, again, the positive delta. So you see, again, buying, absorption. So I'm looking for this to occur at the levels that I marked up. So I'm going to wait a second while it lags. I'm just going to give it one moment. I don't know why it's doing this. Glad everyone can still sort of hear me. Just set the chart up again. All right, so when I'm using ExoCharts, this is how I'm using it, right? So another thing to point out, and this is where, so this workshop is not going to go tremendously into ExoCharts. That's the purpose of all the roadmaps I'm going to be doing. So you can really fine-tune these methods on that. So for example, when we look at, all right, areas where there are zero prints, okay, at the top, okay, price is moving through seeking out liquidity. So if price is right down here, okay, and it is currently moving within a range, it is seeking out liquidity. And what is liquidity? It means there's passive order flow at the bottom, passive order flow at the top, okay? So passive meaning there is no one that is actively making an effort to move the market. So when price comes up and we see that there is a zero print up here, okay, what that means is that yes, okay, up here this was passively sold, all right, so there's passive sellers up here, but there are no aggressive sellers at these 2 points, okay? So when price walked upward, it didn't find any new sellers. It didn't find any interested sellers. So price will end up finding areas where buyers and sellers are interested. So as hard as this is to understand, when there are zero prints like this, typically you're going to see reversals from those points. So price can move back to an area where people are interested, okay, where their active selling is interested, where your market makers can make money on, the collection between the spread, okay, because you have to have people that are willing to jump the spread. All right, in this case, you want some active sellers. You had active buyers up here, so you had clearly 157,000, all right, but not much volume as you move up. So as you can see, the volume as you go up dissipates, okay, because people come less and less interested at buying. Large portion right here, but none up here, all right, all trap traders. So when I'm looking at ExoCharts, this is the thing I'm doing. I'm actually looking at levels, okay, and I'm going down to those levels at the atomized scale, and I'm going to observe whether or not there are these divergences. So when we see, again, to go over what divergences are before I start mapping out the chart again. So when price moves up, if I see that delta is moving up much more aggressively, so in this case, we don't have a positive delta for that one, but I want to find one. See if I can find one immediately. So let's see. Well, this is clearly price moving up and delta is decreasing, so that's clearly is an example that active sellers are coming in. But what I want to notice is if you go on tensor charts, you can see this in the line. So we'll go into tensor really quickly. Bear with me for one moment. So tensor is going to make this a lot more easy for you to see if you're just starting out at this and you're not willing to really, you can't really figure out the footprint charts yet. So we could put on the CVD, and we're going to see there are periods where, I'll put on the CVD divergence. Let's put on 10. Okay, there are periods where price moves up much further than, okay, or delta moves up much further than the actual price. So when you see that, say for example, price is making a high, all right, and this is what you would observe on the EXO as well. So if price is continuously moving up, all right, and for each move up, it's supported by volume, but the delta is much higher. So if we see that, for example, we're looking at a range more usefully. So if we're looking at this range down here, and we're wondering if we should fade the top of this range, meaning be sellers at the top, okay? Video quality is severely degraded. Oh, I'm going to give it 1 second. Sorry, Dave. Let me see if I could refresh it. Let's see if that does it. Okay, it looks like it's good now. Can everyone hear me now? It says the stream status is poor. So this will still be recorded either way. Alright, so what I was saying was, as prices move, so if we're looking at a range, for example, if we're looking at a range, as price is moving up to a range, so we're going to be trying to sell the range, what we would notice is, if we have these two highs, okay, so say for example, let me just go on the higher time frame, actually, that'd be better, because no one's going to be trading the 5-minute here. Okay, so what I'm doing with XO charts, just so everyone's familiar, because I don't want anyone thinking that order flow is a strategy, okay? It is a thing that you observe. So when I'm looking at trading a range, we're going to see that these highs, okay, and these highs are all going to have different values in CVD. So the CVD that is running down here, okay, so if I go on to the 4-hour and go back to that point, so zoom out, get all the way back there. Come on. We'll see that these highs, okay, have different CVD values. So going down here. All right. Okay. So what I don't want to see, okay, is for the CVD value to change drastically across the range. So I don't want to see that, let's say that as price makes this high, that this high has a CVD that if graphed looks like this. So aggressive buying, but no movement in price. So you have a high, or a highs in a range. Okay, if your price looked like that, so if your price looked like this, that's bad drawing. Jeez, gotta get this artwork down. So here we go. Take these two highs. So we're looking at, no, you know what? It's much better if I use a line chart. There we go. So line chart, okay, so this high and this high, right? So if we're looking at CVD, whether or not you're looking at the values on this, so the running values here, so taking the high from one high, so 102, and then looking at the next and seeing it's, you know, we're looking at the previous one and seeing that it is 18 million, and then the next seeing it's 106, right? Even looking at the individual deltas, so 42 million contracts versus, you know, 36 million, 62 million. All right, what we would notice is that price is not moving upward, okay, but the CVD is going up much more. So aggressive buying into the top of the range. All right, so when I'm observing order flow, I'm noticing that there's this divergence, so there's passive absorption right here. So that is, you know, that's all going to be, that's all available in the, you know, it's stuff that I'm loading in Roadmaps. We put up videos on that so far. I just want to make that clear that order flow is not a strategy, okay? It is a thing that we're observing. We're marking up our charts still the same way. We're still trading supply and demand, but we're trying to pay attention to what is going on at these key areas. So one more thing to get into before I start marking up setups is I mentioned you could spot absorption by looking at tick charts. So if you have XO, go down to a tick chart or a volume 500,000, okay, mid-size volume. All right, what you'll notice is there are points where, all right, let me refresh that because it just disappeared on me. Okay, so there are points within market structure. So let's look at 7,029, okay, candles down here. All of these candles are created not by time, okay? And this is, I'm just giving you this little hint to how you can start looking into this yourself, and you could start to use this at support and resistance, okay? All of these candles are not based on time, okay? So they're based on volume. So each of these are set now to be a volume 500,000 contract, so 500K, okay, prints a candle. So once it starts making more volume than that, once more volume comes in, it makes a new candle. So the candle size is going to show how much that amount of volume moved price. So if you have really short candles, okay, what that says is for all of the volume that took place, the price did not move much, okay? Meanwhile, down here, the same amount of volume moved price a lot. So when we see areas at highs and lows of ranges, okay, so if we're looking at the high or the low of this down here now, so we were looking at over here, if you see this, okay, and you notice that the candles are really tight, what that says is the price could not move, but the same volume was created to get this candle. All right, and what you'll typically see is you'll see some type of resting order absorbing all that. Okay, if it's not obvious, it's hidden. All right, so this with a delta divergence, all right, is awesome opportunity to identify where you want to fade. Okay, based on market structure. So look, we have the cumulative, we have the delta divergence here as well. So for example, price is moving sideways. Okay, sideways price. It's constrained now by each candle being printed by volume. So 400,000, 400,000. Almost double, right? 500,000. Okay, but this is constrained for 500,000. So moving sideways, this candle, okay, the delta right here, okay, is almost twice these, right? But price does not move much at all. So there's a ton of absorption up here. So you could set these candles to delta, you could set them to volume, and it's going to make a candle not based on time. It's going to be making it based on the either amount of buyers and sellers. So aggressive buying, it's going to do the same thing. So say, for example, that we see a period which now the setting is on 10 million, right? So the delta being 10 million. So when there are 10 million contracts bought more than sold. So for example, we see that some 10 million candles make large candles. Some make really small candles. So when they're making small candles, what can we expect? That the same amount of volume that made these large candles here is making less of an impact over here. So just something to keep in mind. You have to really, with order flow and with XO charts, you have to observe the chart. You have to understand what goes into printing these values. So what does it mean? What does delta mean? Okay, what does it mean when the candle is really small but the delta is really high? All right. So there's a lot of buyers, but they didn't do anything to price. So that's all going to help when it comes down to identifying entries and exits. Okay. So entries and exits. Okay. The most important things are obviously answering those questions that we were talking about. So answering questions, what is the higher time frame trend? Okay, marking up our charts first. So again, let's just get these lines down. Talk about, given the most recent price action, why these areas were so worth fading or so worth buying. Okay, not a whole lot that's going to be talked about when it comes to worth buying, but just to get it out of the way. So making sure that I have everything. I did not save this yet. Okay, so let's include these wicks. Now let's go down to the 4 hour. Okay. Okay, so the first thing that we do, all right, is obviously we're identifying those questions, the answers to those questions. So we had the trend, it was up, okay, sellers in control. These are all things you're going to be able to answer right away. So sellers in control, we lost this market structure over here. Okay, so now your options for entry are going to be based on the time frame that you're entering in on, okay, and the likelihood that the move is going to either take a long time to transpire or whether or not you're going to have any time at all. So what we have over here is the first example that I was talking about of a backside entry. Okay, so backside entry, meaning that price on the higher time frame, so for a higher time frame participant, this was the backside entry. We lost the top, we're retesting the area that was majorly important. Now a higher time frame participant, what are they going to be doing when they're entering? They have a little bit more time, okay? Their backside entry is not the same as you know, yours if you're on the lower time frame. Now why? Because they're swing trading, they're position trading. This is their backside, okay? They don't need to see this really break down because this was the area it broke down from. So what you would be doing is placing limit orders, all right, at this area. And what you'd be doing if you're trading on the higher time frame is you'd have the luxury of being able to get in with some type of time, right? You wouldn't have to be worried about price getting away from you tremendously quickly. Okay, but you'd have to understand where you'd be defining your risk, right? So in this case, your risk would have to be defined on the most recent high of the structure if you are considering this a swing trade. Okay, you could have a really tight stop if you're anticipating this being rejected right away. But this is a higher time frame chart. We have to expect that price is likely going to be hunting out where you would put your stops, right? Because if I am someone on the other side of the market and I'm trying to fill my liquidity, I want to know where you are, all right? Where do many traders place their stops if they're looking to short this? Probably based on this high, probably based on this high, okay, probably based on this high, all right? We see we have to give price a good amount of breathing room. But a backside entry, this is the perfect example of it right here. So price comes up, consolidates. This is your range that we're auctioning within. Okay, so looking at volume profile, okay, where does price come back up to? Comes back up to test this value area as indicated. So comes back up, stops right here though. Okay, so right at the value area. It's never making it back into the value area. It's not gaining acceptance again into the previous auction. So this previous auctioning environment, this previous range that was created, it's a higher time frame range with multiple ranges within. It's never accepted back here. So as a trader who's looking on to put a some type of limit order on, you have the luxury of waiting for this to show some type of failure rather than having to get in right away. So what you would want to do if you're a swing trader, if you're a position trader, is see rejection first. Okay, you're not going to be just immediately placing some type of limit order here to catch it. So I'm not immediately saying, okay, I'm staggering limit orders right here, okay, based on this, all right, or based on this, okay, because if you did that, if you went off of these lows, all right, so go down to the 4 hour, if I went off of these lows, okay, and I was selling this market, well, I probably became a buyer right here. I was probably the reason why this happened, okay, so if I sold right here, once price moved up against me this far, I was out of the trade, right? So there's no way that someone was going to be that comfortable with price being up here and them opening up a short down here. So people talk about waiting for confirmation, whether it's a 15-minute candle close. When I'm waiting for confirmation through an area, that's when I'm going on to EXO as well. So I'm looking at either the 15 or the 30-minute. The higher the time frame they use, the less, the more there is a chance that the opportunity will be behind you. But what I want to see, all right, if I go, let's go to the 4 hour. Let's back it up a notch. Okay, a few notches. It's been a while since that occurred. Okay, what I want to see is that there's some type of rejection, all right, some type of acceptance above the range, back into the previous range. So if I'm looking at a 4 hour candle, I already see that there isn't, all right. I'll increase the tick size just to compress this a little bit more. But I already see that there isn't. What I would see if there was some type of acceptance, okay, I would see more of this value area being up here, and you'd have less of these single prints in this wick. So if I'm looking at the bid-ask profile, I'm going to zoom in, you can see that this was aggressively sold as well. So aggressively sold up here, there are not only there responsive traders in passive order flow, but there are initiative traders selling this actively, aggressively, right? So they're entering in immediately at market, selling this. There's not a whole lot of volume that took place up here. If I'm looking at the volume profile, if you're looking at the cluster, it's going to show you how light that was. All right, there's no real acceptance over here, and we didn't close through it. All right, if we were on an hourly, if we were on a 4 hour, it would make a difference. It's going to show you the same thing. It's going to show you that we weren't, by any means, there was no close through this area. So confirmation using order flow, using footprint charts, you're going to be paying attention to whether or not we've actually not only just closed with a candle body through it, because, depending on what your setting was, you might have said this is a close through it, but it's not really a close through it because there was no volume up here. All right, no volume came in afterward. So if you're looking to sell this market, you want to see that there's clearly a rejection. You're always going to get a second test. Now, why are you going to get a second test? For the same reason that if you're looking to buy, and if you are looking to long, where can you expect to long? Okay, many traders would be looking to long pullbacks to the 382. Okay, so if we're looking at, if you're on the 4 hour chart now, and you're trading based on the 4 hour, all right, we're a 4 hour trader. Where's the 382? We never really get there. Okay, we go to the top of this candle wick, come down, but at this point it's fitting. But nevertheless, all the way to the top, traders going to be looking to buy at the pullback to at least the 50 after a major breakout. So you're going to have traders that are, one, acting on their own discretion. You have traders that are, you have algorithmic trading programs that are going to be acting based on pullbacks after this amount of movement to the 50 point. Okay, just basic mean reversion. All right, being that price is likely going to pull back, but we could expect some type of bounce. So you'll see this. So any time you're trying to get into if you have a major impulse like this and you miss it, wait till it begins to settle. Just put a fib on it. All right, and I would say that 8 times out of 10, you place orders at the 382, you're going to catch a pop right up to the midpoint. So for large breakout trades, keep this in mind. The 382, all right, for any type of impulse move, it's going to be your opportunity to get into a trade if it's getting away from you. So you can see that if I include this, or if I go down to the hourly, so this is where fibs come in handy, because there will be a lot of program trading systems that are going to be using fibs. So if we're looking at this large structure up here, all right, take the fib tool. That's not all the way to the top. Sorry, guys, I clicked it too fast. It doesn't make a difference. You get it. So whether or not it's here, the candle close, up here, okay, you're going to get confluence, all right, where you're going to have buyers looking to step in this area. All right, if I go further up, it's the 50. So I'd say what you can do is you can take your fib tool, all right, and you can highlight these areas. So the areas between them, all right, the background area, you can have this area highlighted so that you know you're looking to buy pullbacks into this area. So if you're looking along and you want to use the fib and you're looking to get in on some type of pullback, all right, highlight this area on your fib, the 0.5 to the 382, and this is going to be where you're going to be placing limit orders. All right, so you're going to be placing limit orders and you'll scatter them. You're not going to be expecting to get filled in one area, but you have to scatter a certain amount of limit orders, right? So say you have an entry price, say your position size is $10,000, you know, each limit order will be open for, it's got to fall obviously within your risk limit. So if your stop, your position sizing based on your stop distance and your initial risk that you're willing to risk, okay, and then you divide that up, say you want to scatter it over a certain area, expecting a pullback into that area. The more that you scatter it up, the more likely, obviously, you can expect that you might be filled at uneven prices, but you're going to get an average fill of a certain price, and also, obviously, you might miss a certain low getting filled. So if you're looking to get a pullback and you have a low limit order placed down here, you might miss out, right? But at least you're going to catch something. So I suggest using limit orders when you're trying to catch price. So if I'm trying to catch a pullback, I'm not totally sure about where price is going to fail, or I'm not sure where it's going to pull back, but I know that in a given area, I could expect it loosely to interact with that area. So if we were looking to fade the backside of this move, and I said, remember I said that areas are not always going to be precise. Okay, so sometimes we'll just box it. This is how we can scatter our orders. So you place a certain amount of limit orders on the backside of this. Okay, so you see, for example, that this is failing. So we see that this is failing. Okay, 2 major rejections. Price can do anything it wants between here. This is just the unwinding of the energy that's still coming through. Okay, you have people that bought here. They're expecting this to rise. You have people that are looking to sell because they're still expecting this to be the retest of support and resistance. There's going to be a lot of noise that goes on here. But nevertheless, you place your limit orders in this area. After you see the price is rejected, okay, this is when you can start placing limit orders, because you're not going to expect this to immediately reverse. Okay, we didn't expect it to reverse 100% by any means, but if this occurred right here, you're not expecting it's going to occur right away where it rejects. You know, you watch, you pay attention to this on the higher time frame, you see the things that we saw, for example, that we pointed out in block roots. You saw the divergences back here, okay, where buyers were buying aggressively. You could put on a position with some type of patience at this point, okay? So for the higher time frame trader, trading on the weekly, trading on the daily, this is his backside entry, all right? So this is his backside entry, the breakdown right here, puts limit orders here, and then when price starts resolving in his intended direction, then maybe he adds on his position, okay? And it's fractal in the same way that price is fractal, okay? So your entries are the same, right? So this is now another case of a range being lost. So where's the backside entry? The backside entry is right here, okay? We saw that again on the 15-minute this morning. That's the short that I got in. So these are the shorts I got in on this entire way down. Okay, you saw this the entire way down. Now what happens is you'll build a range, right? So build this range. So we'll just consider them boxes where these fights took place. And now we know what's going on within these areas. So when we are, for example, we are, say, long, okay, and we are currently long underwater down here, okay, or no, let's say, I'm sorry, that we are currently short. Okay, price comes down here, we might take profit here based on this high. Okay, we are helping create this impulse. So when price is in a downtrend, you have to remember that the shorts are helping these pops. So don't mistake these pops for a reason to be confident about a trend change. Stay with the higher time frame trend. This was just a major rejection. The backside entry might make you think that this could potentially, what is this going to do? Come down here and then nuke through here? It's likely not going to spend as much time as it did below this area, only to nuke back through here. Okay, and that's why we define our risk with the backside, because at this point at least, we have this major area that was lost. We have this area, we can put our stop here or our stop here, okay, depending on how tight we want to put it on, how much of a position we want to take out, okay, and we have this comfort zone, all right, because we know price is not likely going to nuke right through here. It was just rejected right here. All right, it's not going to get rejected here multiple times, come down here, get rejected initially, and then pop back through both. All right, and on the rare occasion that it does, this is why we define our risk. And this is why the backside allows us to define our risk relative to market structure. Okay, so the range or the area that we're looking to enter, okay, is, again, we open our volume profile. So the parameters that we're setting, the value area low, okay, so you could see maybe how it's blue, it's a little bit darker in the value area low, so there's the high, there's the low of this range. Again, the area that we're retesting and we don't want to get committed back into, or we don't want to gain acceptance back into rather, so is the previous auction. So rewind the tape. The last thing we want to see if we are short is acceptance back into this auction. So you have a few different things that are quite obvious at this point and can make you a little bit more confident. All right, you have the clear rejection here, and then you have another rejection. At this point, you can add on to the breakdown, because you have to remember, this is a breakdown of a larger breakdown of a larger breakdown. Okay, stick with the trend. The trend and the tides have begun to shift. All right, you have a little bit more confidence now in taking the short side of the market, in assuming that it's not just going to reverse in your face. Okay, so the backside trade, this is just, it's funny, right? So the backside trade for the higher time frame trend, okay, was this. Breaking down, retesting here and failing, and then the backside trade for that failure, okay, is within the same trade. Okay, keep this in mind though. Keep the higher time frame trade in mind. Okay, and then you have another backside trade down in that one. So you can imagine how crazy and wonky this can be, and how it can go down to. It's just fractal, right? That's just the way that price behaves. Okay, much more loose on the lower time frame. But now that we understand, okay, this is the backside, right? This is the same for the longs. Okay, so longs are going to be based on market structure as well. We're going to be talking about ranges. Okay, so, excuse me, I have a text. Let me turn my phone off and throw it across the room. So when we're trading ranges, okay, using this range as the perfect example, okay, you can take multiple trades within this range. All right, if you are a higher time frame participant, your constraints are going to be based on the exteriors of this range. All right, there's no sense in you getting committed before here. All right, so if you do commit, right, if you notice there's weakness below here, yes, you can place your stop above here, all right? But in this case, this is a middle ground. This is not somewhere where I do want to be caught off sides, okay, because there's really no loss yet. All right, you can see price can continue to move within this and give you the confidence, multiple times over, just like from here to here, that it was going to break down, right? So as we approach these lows, pops back up, okay, pops back up, popped up over here. And it's not that eventually it breaks down and we saw it did, it's that how are you going to feel when you place the short over here and you get the pop up? You're not knowing that this eventually happens. You don't know that that happens, right? You don't see the future. So every one of these pops is going to feel like the pressure, the fire under your feet that is going to give you that a little bit of sweat under your, in the palm of your hand. So rather than do that, we have to consider, all right, how are we trading? What time frame are we trading? Are we trading the higher time frame? Because then we're looking at this range and we're looking at the breakdown of this range as an opportunity. Okay? Or if we're trading on the lower time frames, we're acting within the range. So I wish I could get the chart to stay. So when we're trading the lower time frames, there, I'll stay on the hourly. Sorry, guys. Okay, that is when we could take out the volume profile for, say, we have a decent amount of the range painted. Okay, so in this case, we have a swing high, swing low, the immediate swing low, the furthest swing. I'll go to the highest swing low. Okay, so now value area high, value area low. All right, the major low. So now you have key areas in mind where you can expect price to interact. Okay, so if we're just looking at this from a structural standpoint, lows, midpoint. So if you want to take the 50, Okay, I'm going to change the colors now. What I would say is that for the lower time frames, background, that I'm going to be less concerned on lower time frames about the volume profile within this influencing the trade as much as the actual midpoint and the structure within it. So midpoint, high, low. And now if we're taking a trade, we're going to be trading based on these 3 points. Okay. So I could take a trade within here, not anticipating a breakout to the upside, not anticipating a breakout to the downside. My trading is confined within this area. So when we approach a value area low, when we approach a value area high, all right, we could expect that in this range, being that the higher time frame trend is down, that there's probably a higher probability of taking a short, okay, than there is a long playing out because the higher time frame trend is down. All right, but nevertheless, the opportunities to fade these moves will occur multiple times over, and you're going to have the fear that always occurs. Okay, and remember I said evolve your charts as they move along. So this high over here, okay, you can see how on the lower time frames you evolve these as they move along. So these lows here, these highs here, you can see how they move throughout they progress throughout the duration of this chart. So if you're trading on the 30-minute or the 1-hour time frame, okay, you're going to be paying attention to the auction or the rotation between here. Okay, and this is when you could go onto the 15-minute, onto EXO charts, and begin to look for either the absorption, all right, or the aggressive selling in these areas where price is not moving, okay, or the aggressive buying in these areas where price is not moving, with anticipation of fading this, okay. And in this case, anytime you're taking any type of entry, okay, if I am a short-term trader, intermediate-term trader, and these are my highs and these are my lows, okay, this is structure. Okay, if I went on to the 4-hour, and I'll just make this a little bit more 4-hour oriented. Okay, if I am trading within this, all right, my targets have to be the immediate areas I expect price to have trouble with. Okay, you cannot take a trade, all right, a long that is a long here and expect here. All right, that's more often than not what you see people doing. They're longing here and expecting here. Okay, clearly the first area that price is having trouble with is right here. Okay, so unless you are willing to give price an adequate amount of room to breathe, okay, and you're a position trader or a swing trader and you're taking a smaller position, you can't take a trade with high leverage here, with a large position, with anticipation of these hopes and dreams up here. And the same way, if you're a short, okay, if you are shorting this point right here, all right, and you've seen multiple areas of interaction, okay, so between this area, okay, you're confined within this structure. Okay, so when you're trading a range, you're confined first to the range. So it probably took a little bit for me to get to that point, but you are confined to the structure of the range. So if I am trading, get rid of this, delete, let's make a range. So if I am within this range, all right, and this is the pattern that's painted so far, okay, I'm not interested in, get rid of that again, I don't know why that's disappearing, why are you doing that? What's wrong with you? All right. Okay, so if I am currently here, you are here, this is your map, all right? I am not currently taking any trade here with anticipation of breaking out of this range. It doesn't make sense to. It's not the high probability trade. The middle of the range, this area in the middle, is where you get caught flat-footed because you take trades here with anticipation of them going further out here or further down here. And what happens? Price can continue to range for a long period of time. And when you're currently in a short from here, anticipating that it goes down here, but it goes up here, it's not that it eventually can't come back all the way down here. It's that when it comes up here, you think that you're going to hold on to the trade? Probably not, right? You're probably not going to. So you have to keep this in mind. When you're trading within a range, you have to keep the range in order of priority. You have to keep the range first and foremost. Okay, so if you're trading a higher time frame range, it's a higher time frame range. If you're trading a 15-minute range, it's the 15-minute range. Okay, you're not going to be taking a trade from the middle of the range right here. All right, why does this line keep disappearing? This is where New Yorkers break their computers. So you're not taking this trade, okay, with anticipation, especially if the higher time frame trend is down, taking a long here with anticipation of breaking out, okay? Your first areas of business, if you're operating from the center, All right, so if we're operating within this area right here, okay, if we're operating right here, we're not anticipating up here or up here, okay? Clearly, there's multiple rejections between this structure. The only thing that we're first considering as a target is the next area of business, okay? Your next order of business is always where your last order of business was, all right? You're not considering anything more or anything less. That's when you start, telling yourself a story, start spinning a narrative and expecting that you're going to be catching the move that takes off into the next greater move, all right? So look at things first within the range, okay? So first from the higher time frame, all right, so we saw the weeklies. So let me get these lines back on. I wanted to hit that point, but let me just keep deleting this. I have to save this chart again. So if we're approaching this right now to keep this relevant to what we're doing. Okay, so as a perfect example, we're currently in a higher time frame downtrend, all right? The reason I'm not looking for longs is because the longs right now are the ones that are going to catch people off sides because the longs have an expiration date. The longs expired up here, all right? People started talking about this being in play, about this being in play again. It's almost like they forgot that price was rejected after this record move. It retraced all the way and lost this structure. So we know what the trend is. It's down. The first order of business is not longing anything above this structure. All right, so this is what we're confined with now. All right, this is what we were confined with. We broke through that and we turned it to some type of support, or being that we turned this area to support. That's great. The next order of business was here. So these are the two areas that we had to be confined within. There's no reason to have hopes that any higher is occurring. If you're a short right now, or if you're looking to short, within this range, okay, exists the higher probability short entry, though, for the larger trend. All right. So to make sense of this, the higher probability long is not within this retest of this low if we're within this range. So if we're on the 30 minutes to make this range seem a bit smaller. So this was the range right here. Okay, so these highs, clearly these lows, this is loosely drawn right now, just to give you the idea though. These highs, all right. So at any test of these lows, if we're going to define our risk right below market structure, all right, testing these lows means next testing these highs. Okay, there's no higher time frame trend entry right here because the higher time frame trend foe at this point, or the resistance, is right here. It's this red line. Okay, but that being said, within the same range, there is an opportunity for a higher time frame entry. Okay, because the trend is down. So because of that, the backside entry was right here. Okay, whether it was right here or right here, you had it loosely done. The backside entry was here for the higher time frame trend, but the short-term trade long was down here. So in this case, I don't even bother looking for the short-term trend, the short-term fading of the trend. I only just stick with the major trend trades. All right. So backside entries. Getting back to that point before I went off on a tangent, but it's it's my live stream. This thing can go on for a while, so I don't want to keep it past 2 hours, but it's all right. So this was the backside entry for this. Okay. Within these, we've said we've had backside entries. So what are long entries then? So if we have market structure defined as some type of range, okay, so we've defined this range. My long entries are not going to be based at all on the midpoints of the range. So I'm not basing them on this area, okay, so here at all, okay, because at this point, if the higher time frame trend is down, all right, I'm not interested in this. Okay, I'm certainly not interested in this. Okay, from a probability standpoint, not interested in up here. Okay, unless this is the short opportunity, I'm not interested in a long opportunity up here. I'm not interested in a long here. I want a few trades that exist that are high probability. Okay, it's the short opportunity here. Okay, after the breakdown and retest of major higher time frame, and it's the breakdown. So breakout, okay, breakdown. So there are two trades that exist in the higher time frame trend that is moving down right now. In here, my only trades are short trades from here to here or here to here. And the problem with this is why you get caught so flat-footed is because when the market is rotating within a range, it could do a lot of different things. It could spend a lot of time rotating from high to low. All right. There's no telling how many times it can go from one high to the next. So it can do this over and over and over again. It doesn't change the fact that it eventually breaks down, or if it has been moving up, that it eventually moves up. All right, a lot of this can be noise. Okay, so knowing that this is all noise, I want to position myself so that I'm safe within this noise. So I know my longs are at the bottom of structure or at the tops. Okay, they're at the tops. The only time that I'll consider buying in the middle is if it's some type of flag and it's flagging upward. All right, that's the only time because price is compressing as it moves upward. We've all seen flags before. If you've seen them, typically you see them more on the lower time frame. All right, then on the higher time frame. On the higher time frame, they typically break down. So this looked like a flag over here, and what happens is, again, as I said, you get those trapped moves where price shoots up. So whether or not you're drawing this flag or you had this flag, okay, price breaks above here, triggers everybody, breaks down, and then you have no support on the bottom when you crash downwards. So trading ranges, I want to get back in line with what I was originally talking about, trading ranges and trading backside entries and how that works on the inverted scale as well. So backside and front side. So draw the range. So when you're defining a backside entry, okay, you have, ugh, that's ugly. Why is it doing that? Okay, get my drawing tools out. Apologize, guys. So major rejection at the area, okay, breakdown, and the retest. The only time that you have to market order into something is when the market is violently moving away from you. If the high probability is that there's no support, okay, or rather that since there is no support, there is reason to believe the price is going to move rather quickly. Looking at previous structure, this is not an area where I would assume that you would need to enter in with a market order. So if we're looking at getting in the backside entry based on this structure, we use a limit order, all right, because we're not expecting price to skirt away from us. We could comfortably put on a limit order with expectation that we could get filled, define our risk by the high of this structure, all right, in anticipation of what? Testing what? The first area that price would likely test would be the area that was the high of this range down here. All right, so from a market structure standpoint, it would just be this, 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 and that's it. All right, so what you'd be doing is saying that your invalidation would be here, okay, your entry is over here, and your low, your first area test is here. All right, don't set the trade up thinking this, okay, thinking I'm going to enter here, and then my target, because it makes my risk reward look great, is right here. All right, so this looks attractive, but that's not reality at first, because at first you have to deal with the fact that there's major structure right here. All right, it ended up giving way, which means you add on your position, but still you have to maintain some level of realism. Okay, you have to be realistic rather. All right, the higher time frame participant existed right here. Okay, so this goes back to the first few parts of our questions we have to answer. Okay, where are the larger players in the market? Okay, what is the overall trend? Okay, where are the higher time frame participants? And this is a majorly important area, so we're not going to expect that price is going to do anything but interact when it comes down to here. All right, how it interacts when it comes down to here, that could either build our confidence or weaken our confidence, but nevertheless, we have to be realistic and assume that price is first going to interact with here. Okay, the only time when we could put on some type of short with anticipation of lows checked or much more movement than what appears, okay, is when we have some situation like we have right now, okay, where this is the backside entry, all right. In this case, where would your stop be? All right, depending on what type of position you're putting on, okay, your stop would likely be based on most recent market structure, so it would be based on this, okay, in anticipation of testing the lows again, all right. Why would it be testing the lows again? Because at this point, this is the only structure down here. You can see that this whole area is pretty much void, all right? So we anticipate that since there is less of a pattern that is painted from here to here, and this is more likely just what we would expect after a major sell-off, okay, just some type of correction or rally, that if we're fading this being the higher time frame resistance, that we can expect to test these lows, all right? We can expect this to occur. How long it takes to occur, all right, that remains to be seen. Whether or not this comes down here and then comes back up here, this is the reason why it's important to take profits, okay? That's something I have to remind you of as well, is taking your initial risk off the table, all right? So backside entry is for the shorts, all right? When we're taking a backside entry, we're defining our box, okay, so where buyers and sellers are battling it out. The higher probability trades are always on the outside of this. So outside after the battle has been resolved. You're going to lose what you could have had if you entered in here or here, all right, clearly. but there's more certainty after a pattern is printed and fails that the retest is going to hold. Okay, you have more certainty, you define your risk better. All right. Now, that being said, the long opportunity is the same exact thing. All right. But the higher time frame trend has precedence. So with this, again, the higher time frame trend is now down. Okay. With this, consider like the order operations in math. Okay. This looks like a box down here, a consolidation period. Okay, but it's deceiving because this was the higher time frame rejection over here. Okay, so if you're taking a long here, you're lucky if you get a test of this high. Okay, so if we're looking at the market and we're on the sidelines, this is how we're weighting our opinions, okay, on whether or not it is a valuable trade or not. Okay, it doesn't make sense to try to take a long in a market that is moving down like this, okay, when you should be looking for the stronger opportunities, which are selling this high or selling the breakdown. Okay, so if we are currently not long, okay, we would be looking to get in on shorts under the same premise. Okay, so say for example, right now we're being rejected. Okay, if we have this consolidation period right here, so price has been rejected already. There's no real clear backside entry up here because it has already occurred. Okay, because that has occurred right here. Okay, so we have this consolidation. You could consider this your second chance to enter in. All right, so second chance at backside entry, but the problem is this is likely painting a range. So you could get this backside entry to be a higher time frame participant, meaning you could enter here with expectations of, testing these lows again. Okay, but you have to be willing to accept that the pain of price moving against you coming up to this point. So price comes up here is completely fine because your stop is over here, but you have to be willing to accept that. All right, that you're a little bit late to this at this point. All right. Now, with longs, all right, and you're longing in a bull market, it's different. Okay, because with that, at that point, your backside entry are these retests, right? So if you're trading based on where these fights occur, okay, your backside entries, I'm going to flip this chart upside down so you can see it. Same thing, okay? So your backside entry in this case is you failing. All right, let me highlight this because now it's on the, got to get down to the 4 hour. Okay. Here's your rotation period, price battling it out. This is your failure right here for your long. These are your retest opportunities, okay? They're opportunities because at this point you have a higher level of certainty. The price after breaking out of this range of painted is going to continue upward. All right, you could define your risk. So we're shorting this long right now. That makes sense. This next point, plenty of noise to get chopped up in with less certainty. And these are just going to be trades you're going to be adding to your skill set, your list of trades you can take. These opportunities where you have these breaks out of these, just consider them consolidation periods, ranges, brackets. Again, here's your backside entry for this long, right? Retest of right there is rejected though. So it just looks the same from the other side. All right, the same way that this long played out for a short. Okay, so these were our battlegrounds. Okay, so you can see this top. This was the top of the market. Here is the retest. It looks like a bullish retest. Okay, and now the area that was once resistance. Okay, this major area, right? Let's just line this up. These highs. Okay, consider this now. This looks like the fake out. Fake out. Come back down below. When we have a breakout, what do we go to do? We go to retest. And what happens when you retest? When price comes back to this area, anyone who was currently short, so think about it in this standpoint, it was a long. Anyone who was currently short, when price came through, as price came back down, they were like, I'm getting out of here. They bought back in, and they create this movement. They create this momentum moving upward. So the market looks the same up as it does down. The only thing that it leaves out is actual context. All right, so what is the current environment? What is the sentiment? Okay, that's the thing that it's leaving out. But it's still structurally, it's doing the same thing. All right, so the market is going to spend a lot of time ranging. Okay, so being that it's going to spend a lot of time ranging, we need to start looking for trades that set up for range trades. So we have a high, we have a low. All right, and I'm just saying I don't trade the midpoint. Okay, I don't really trade the midpoint unless it's a clear uptrend. All right, in a bull market. So, say for example that we're currently in a pattern like this. Okay, looks like a continuation pattern upward. All right, at this point, if we are, like I said, if we are flagging, it's going to look like the midpoint is tested, right? Because at this point, your high and your low have done this. You've gone from spending time in between this range to spending a majority of the time upward. At this point, at least you know that the trend is upward, okay? The trend is upward, and you could define your risk as this low, okay? Because if you're buying into this with anticipation of moving upward, you don't want price to come down here, okay? You want to be out at that point, so you define your risk at that point. But I'm not looking for, what I'm saying is long-term trades within the structure that we currently have, because you have to deal within the fact, well, you have to deal with the fact that right now we are painting a likely a higher time frame range. This could go on for quite some time. There's no reason to assume this will break out yet, but the overall energy is down. Okay, the overall energy of the market is down. So for that reason, I'm not looking to long. Okay, I should make this more clear. I'm not looking to long midpoints in a bearish trend, and I'm not looking to short midpoints in a bullish trend. All right, I think I left that part out. Okay, so I'm glad that I just mentioned that. For midpoints in a bullish trend, I will consider longing them. Okay, for midpoints in a bearish trend, I consider shorting them. But I'm not looking to play any fading of the major trend from the midpoints. All right, I think I left that part out. Something tells me that I left that part out, and that was a crucial point to make, because otherwise it sounded like you just don't take trades in the middle. You don't take trades in the middle with hopes and dreams that they're going to change the actual trend, right? You have to consider that these have a shorter half-life, right? Does this make sense? I just want to ask if anyone has any questions first before moving forward. I can't believe I left that part out. Give everyone a second. Okay, questions yet? Cool. Ask away. Oh. Oh, yes, too, you can hear me. No, okay. All right, so if we're painting a higher time frame range, okay, here's your low. Some people are really good at these drawing tools. I'm just not. Midpoint. Okay, define the low, define the high, define the midpoint. Let's look at the volume profile moving forward. Okay, now we know what and we'll change the ink color of this now. Now we know what our value area high is, what our value area low is, what our point of control is. Okay, so now I'm going to remove my drawing tool. Okay, I can see where the gaps are that occur in this. All right, but now I know where my middle point is and my value area, my midpoint and my volume point of control. So that's this. Okay, I know where my value area low is, right here. Value area high is right here, the high of the range, the low of the range. So now I know exactly where I am willing to deal, okay, where I'm willing to play, all right? As I said, I know what the answer is to all those other questions. I know currently who is in control. I know that sellers are in control, all right? I know that regardless of what it looks like, price can give you any type of impression that it's bullish, but you expect a really strong rally in a bear trend. It just eventually comes, okay? But my higher time frame thing to keep in mind was this resistance up here. So just as if I was approaching this trade, all right? So keeping in mind this, what am I considering? Yes, you can take a lot size, like how many, like position sizing, do you mean, or just trading with some type of predetermined lot size? There is a video on position sizing and how to do that. And then lot sizing if you're referring to me talking at like giving education on different lot sizes in traditional markets, then no, there isn't. Like if you're talking about, let's say a a tenth, like just thinking about a block order, for example. No, I don't have anything like that. You determine your lot size though, and you should. If you are trading, if you've been trading for some time now, you should have your lot sizes broken down so that you can have a predetermined idea of how you're going to scale in with limit orders when you are scaling in with limit orders. So if I am, say for example, trading with $10,000 and I am looking to enter in shorts on a pullback to this high, okay, well I would probably be scaling in, okay, because I'm considering this area that breakdown would occur. So I would probably be scaling in with limit orders right around here. Okay, I'm going to stagger limit orders, and if I'm trading with $10,000, I'm probably going to place at least half of that, okay, in the first part of this, okay, and the remainder a little bit higher up. All right, or rather, excuse me. Hold on one sec. Let me make these a little bit thinner so it's a little bit more obvious. Okay, so if I'm staggering orders like this, I'm going to be breaking down, say I'm taking my 10,000, I'm splitting it up into orders of 3. I'm going to be taking that and dividing that over this area, and I'll put a bulk of the amount in the beginning, okay, and I'm beginning to taper it off at the top, all right? Or if you are, say for example, a little bit more risk averse, what you can do is you can put less of it in the beginning, more of it at the top. Now why is that? Because in the offshoot chance that you fill the first part of it, so say for example you get filled for the larger portion of it, so say you break up 20, you have a 20,000, you're trading on behalf of $20,000 and you break it up into threes. Say you broke up a dominant portion of that into the first order and you put 10,000 in and then 5,500. Well, if you're filled at 10,000 and then price moves adversely against you, you're already underwater with the larger portion of that. All right, now the flip side is you can hedge yourself in that position at that point if you wanted to flip and trade around the position. But what I would say is to keep things simple, keep them pretty even. So if you want to break up your orders for your limit orders, to stagger them in an area, just keep them equal in the beginning until you find a way that you're comfortable trading, and when you get timing down a little bit more. But if you have any other questions about lot sizes that I'm not maybe addressing, just make sure you ask them. But now when it comes to, okay, so this is the higher time frame trend. So I am willing to take the shorts from up here, okay, the shorts that test right here. So just to give you an idea of the areas that, knowing all of the things I know about the market right now, okay, so I know where the traders are offsides. Okay, I know that longs will be offsides over here. Okay, I know that once we're under here, longs will be offsides because this is an area that longs will be looking to enter. So I'm looking to take trades here that are short and here that are short right now, okay? Because right now the highest probability trade is south, all right? So the highest probability trades are this, okay, and this, all right? I'm not looking, knowing what this trend is, to take this by any means, okay? Even though this can happen, it's just not something that I'm considering. I am not considering taking this, okay, by any means. The only trade that I might, if I was, it's not something that I really consider. I've seen a lot of other traders take this trade with alts. It's retests of major swing lows. So yes, if you are willing to step in, right, and you're literally stepping in at the last barrier, which is often, right, point of max pains, point of max opportunity. So if you're willing to, what you can do is, since this has not been tested yet down here, and we know that a ton of volume took place down here, so if I'm looking at, again, if I'm going to use XO, and I'm looking at this low, I know what went down at this low already. Okay, I know that, for example, that this was aggressively sold down here, and that price was aggressively bought out of this location. So we saw this aggressively sold. There's a lot of volume down here. There's a lot of back and forth between buyers and sellers. Look at all these imbalances. So there was a ton of initiative buying out of this zone. So initiative selling into the zone and then initiative buying. And if you looked at this on a lower time frame chart, you'd actually see that the remaining candles that were red or rather that were green, had negative deltas as well. So there was a lot of selling into that, and there was a lot of support. So whenever we come back down and test this zone, this might be an opportunity to take a long. All right, under the premise that this has not been tested yet, and there are likely traders that are placing dormant orders here. So if you were looking to enter, you would probably be looking to enter in where other traders would be filling liquidity. So they'd be trading where other traders put their stops. So you'd be placing a order to buy where other traders place their orders to sell. So right here, right here, right here. And the idea would be that if we come down and test this low again, there's a high probability that if we come down and test this low, like this, that we bounce. All right. Now, that's if we test it vertically. There's a high probability that if we are up here and we test it from down here or from here, that we bounce. All right. If we, on the off chance, come down like this, one sec. See, better trader, terrible artist. If we come down like this, all right, I'm not confident. Okay, if you grind down a resistance, that's bad. All right, if we come down here and spend a lot of time like this and have no interaction, that's bad. At least at that point, you can pull your orders off. All right, but if we come down vertically, I would expect us to bounce. All right, it might look like it's not going to bounce, but it will likely bounce. But nevertheless, knowing the trend, I'm looking for shorts up here or shorts at a breakdown and retest backside again of this. All right, because that is the opportunities that have the highest probability of occurring right now. All right, if we inverted this chart, all right, I don't even need to find something on this chart to show the same thing. If we inverted this chart, it would be the same deal. Okay, inversion of this chart, the opportunities are at the bottom for longs, okay, at the midpoint for longs, all right, and being that we would come up, excuse me, test the high, right, putting in highs, coming back down, showing support, right, at least with this low, we can define our risk relative to market structure, okay, at least we know that the next area is up here, okay, but at this point, this opportunity, it doesn't look good with this one because this inversion is not the best example. So if I actually just get out of here right now, okay, so it would be better if we did not have these three rejections up here, this looks bad, right? So this looks bad because this is a backside short for that rejection. But if we were looking to take a long and this was say this was just one move up like this, the midpoint would be fair game. So midpoint check right here. At least at that point, our market structure stop could be based on this, or if we're placing a position trade or a swing trade, then we would actually be able to put on some type of volatility stop. Okay, I see some people have some questions. I'm going to get to those in a second. Get this chart re-inverted. Okay, so let me back out of here. One sec, guys. Okay, so keeping in mind the higher time frame structure, it's going to dictate what type of trades we're looking for. And if it doesn't dictate what type of trade you're looking for, you're probably going to be trying to take every single trade that the market offers, long and short, and you're likely going to be caught offside. So the overall point of this is you want to be able to say, all right, I have a default setting, the trend is down, I'm looking for shorts right now. Now, another important thing, okay, and this is a really useful thing to remind traders, trading entries do not matter nearly as much as trading exits, okay? More often than not, traders will put on an entry. Okay, so say they, say for example, that they look to short this retest, so this backside retest of this structural area. So this was the retest. Okay, this was a great short opportunity for anyone who's willing to incur the narrative that this was going to pop through and just pay attention to their own strategy. Okay, so say they're willing to enter in here. Would they have pulled off their entire order here? Okay, or they would pull off a little bit. Okay, so this gets into the concept of taking profits and being able to take profits properly. All right, so more often than not, traders will get out of a trade way too early, or they'll get out of a trade too late. Okay, so after prices moved against them, when it's too late, okay, and that's typically because they didn't identify where their target was, because they were a little bit unrealistic. So if we were currently, let's say for example, let's go back into one of these periods within this trend. Okay, so let me find something that's a little bit more trendy. Okay. Nope, that's a bad rejection over there. Okay, so see, we haven't been really trending in a long time. Okay. So if I didn't, for example, consider this area right here. So this, it's really any target, right? So any really higher time frame target. So I want to find a good example. Okay, so perfect example right here. Okay, so this ends up being the midpoint of the structure for this higher time frame structure. You can see it travels through and becomes quite important for the entire duration of this structure. Okay, expand a little bit. So if I currently was longing, like I said, when we approach one of these swing lows, we can expect a bounce. So say I was long this right now, okay? If I did not anticipate properly that this would clearly be the resistance, all right, after painting this entire structure. So we saw this whole rotation, these rotations occur. We know about that. We know that this was clearly the area the price came down and interacted with multiple times, and then it was the last place that price was rejected from. Okay, so you might get the entry down here. Maybe you get the entry late over here. All right. You have to be out at the right time, though. You have to be willing to get out at resistance. Okay, you have to understand that price is not going to test this high. Okay, it's not going to test this high. So what happens is traders get good entry. All right, price comes up and it comes against them. Okay, and then this is where they start overthinking trades and they see it come up against them and they're wondering if it's just a period of a trend beginning and maybe pulling back a little bit. It's just failing. That's what it's doing. So since you don't take profits here, what happens? Price comes against you again and you end up getting out with just this amount. Okay, so just this amount between your low, if you're lucky, if you got this low, and your exit over here because price has already started to move against you. Now, if your hit rate is, say it is one of those 30-40% hit rates, you can't survive on trading like this. Okay, you need to get out at the proper area. So exits are the most important thing. So exits are the first thing that you need to consider. All right, before you are even in a trade, you have to know where you're going to be out. So where am I going to be out if things work well? So if things work well, I'm going to be out over here if I trade this short. So if things work well, I'm going to be out over here, right? But if price comes down here and has any trouble, I have to be willing to take some profit. So maybe I'll take 30% off. Maybe I'll at least just take my initial risk off. So that being said, when you place a trade, all right, so hopefully you're starting to realize that entries and exits are not glamorous at all. All right, what we're trying to do is, most importantly, pay attention to conditions that preceded our entry and exit so that we know that we're on the right side of the market. So we're buyers in control. Yes, okay, longs are looking good then. So from what location is long? Do longs have the best, highest probability success? Well, probably at the swing low, right? Not in the midpoint because there's less, that's more flat-footed at that point. At the high, you're not going to long at resistance, but long in the breakout makes sense. Okay, so we have to think of all these things. The entry is not glamorous, all right? More often than not, people think that the entry is something that's like a hidden thing, that it's like this, what do they call it, the holy grail. It isn't. It's the least glamorous part of the trade. You want to be able to have the trade planned out, though. So your exit is most important. So when I'm taking a short up here, I have to consider that the overall trend is down, okay, but price is likely to interact here first. So taking some off is going to be important. And if you're not taking profit, all right, at least take off your risk. So let's say, for example, that I am risking, my initial risk is, why does it do that? Why doesn't TradingView just intuitively understand what I'm trying to do from my brain? Okay, so my initial risk is, all right, in this case, I'll just use the tool that they give me. So I'm short from this point, okay. My area here, okay, would be, in this case, if I'm getting the backside entry right there, I'd say at this structure midpoint, I could keep that conservatively. I don't want price to be all the way up here, but I don't want to give too much up. I want to have a decent stop, all right. If I am anticipating the price comes down here, and I'm not going to pull some off, you could remove your risk when price begins to move favorably. So if anything, if you're not going to be paying yourself, because we have to imagine the trend is really not in place right now, so the higher time frame trend might be down, okay, or it could be ranging. The problem is that stuff is all easier said after the fact. All right, we're not really certain of what is occurring in the moment, so you don't really know. Okay, is this an opportunity for me to? Oh, that's really nice, Dave. Enjoy the sunset. This will be recorded. So that being said, really quickly, if you are entering into a short trade and you are, say, for example, risking $100, okay, to gain 500. So say your first area of resistance is, let's say it's down here, okay. Take off your risk. So when price moves favorably, take off your $100 that you were willing to risk. Okay, essentially you're buying your stop out. All right. At least if price moves adversely against you, it's not costing you at that point. Okay, so remove your risk. If you want to just start getting the habit of removing your risk, right, it'll make you a little bit more confident in your trades. And what that'll do is, say for example, we're looking to take a long trade, and we are currently, let's say we're trying to get in on a pullback. So we have a range. Okay, we're looking to long this breakout. All right, at this point, let's say our entry would be right here. That's not what I wanted to use. I'm the most clumsy TradingView user. Oh my God, it's like a spider web caught on me right now. All right, so my long entry here, say my risk is going to be defined as the low of the structure. And then let's say that my target was somewhere up here. I hate TradingView. If someone could come out with a better TradingView, I'd pay twice the amount. So say I was anticipating this being tested, and I'm risking, let's say I'm risking 1%. Okay, when price moves favorably for me, take off that. Take your risk. Pay yourself your risk. Okay, at least at that point you bought your stop. Okay, so if price comes back into this area, you've already bought your stop out. Okay, you've already taken your risk off the table. So that's something you get in the habit of doing, taking your risk off the table. This is all in an effort to make sure your exit and your trade management during the trade is in a way that you're able to take a large amount of trades, even having good looking setups, even having good entries, but that you actually pay yourself, right? So that you actually are being able to, or rather that you are actually able to pay yourself, and you're not just hoping the price doesn't turn against you at any point and hoping that you catch the furthest target. Does anyone have any questions? I just want to make sure I look over them. Enjoy your night, Dave. For the higher time frame strategies reviewed here, do they apply to daily and weekly swing trades? Yes. So if I am, it's all very, okay, so price, when it makes ranges on higher time frames and when it makes ranges on lower time frames, the higher time frames have more strength. There's more noise on the lower time frames, but it's the same premise. So if at any point I'm looking at a rotation on, if I'm looking at, for example, this range right here, defining the lows and the high, so I'm paying attention to the order flow that is occurring at these lows, at these highs, seeing if sellers are stepping in here, seeing if buyers are stepping in here. Okay, this is a range that's on a 6 hour. Okay, this range has in mind what the higher time frame trend is. So this has in mind that we just broke down from here. So the higher probability trades are going to be shorts within this range. So they're going to be fading this, okay, fading the highs, okay, fading the center line. These are going to be the higher probability trades because the overall direction is down. Okay, the opposite is true when the overall direction is up. So the higher probability trades when the overall direction is up for a range that is being painted is the midpoints and the highs, okay, and the lows, okay, but in the opposite direction. So the higher probability trade, midpoint is painted, okay, the breakout and retest of this as a long. So long, okay, the breakout and retest of this as a long. The initial retest of this as a long. Why? Because more of this energy is forward moving. Okay, you have the trend in place now after knowing what was behind us. So you have to know where you came from. Why do we say that this had energy behind it? Because it just came out of this long period of ranging and accumulation, whatever you want to call it. It broke out of this violently. So the energy is behind it. So at any point, the point is to look at the higher time frame to know what trade within the middle time frames has more energy. So now that we broke down from this level, aside from short squeezes like this one, trades that have more higher probability of occurring rather favorably are shorts. So that's why I'm not looking for any type of longs right now, because it just doesn't seem worth it. I'd rather be patient and say, well, I'm not really interested in taking a long here because what gives? If a long here is good, it means that this short trade is coming. And if this short trade is coming, I know that the energy is already down. There are a lot of sellers that want to get behind this right now. Okay? And there's one thing to be said for a lot of sellers to be caught off sides. There's another thing to be said for when a lot of people are interested in selling something, it's probably going to go down. So whether you're talking about houses, whether you're talking about cars, if you have more sellers than buyers, that's what makes price go down. That's all it is. Price doesn't go up because of the news, it just goes up because more people are interested in selling it aggressively than we're interested in buying it. So it's aggressive order flow versus passive order flow. If someone's not absorbing that, it'll go up. But right now the overall energy is down. So there is a fractal nature to the way ranges are created, the way trends are created. The only thing is that on the lower time frames, so the same stuff on the higher time frames applies to the lower time frames. So if we're a trader on the lower time frames and we're looking to scalp ranges, so we've established this is current market structure, you have a lot more noise, right? So you see that this is a lot more noisy, okay? There's a lot more money within this small area, okay, in a more confined range. Okay, you have to think about spreads, liquidity, how price is going to jump more down here, movements are going to be less subtle. Okay, so there's going to be more things that might be misinterpreted also. So when you're trading the lower time frames, I would stick to exteriors for that reason. Okay, because the exteriors, all right, and to get back to this point, the exteriors of lower time frame trends, if they line up with higher time frame areas, so let's go higher time frame now. This is a higher time frame area. This is a higher time frame swing low. If we're trading the lower time frame, okay, this is lower time frame, right? But within this lower time frame, we know that the higher probability trades that are within this lower time frame are at the exteriors of the higher time frame. Okay, so higher time frame within the lower time frame. Okay, and what that means is that, say for example, we're looking for, so now we have the exteriors is a midpoint. Highest probability trades are going to be up here. Okay, the first test of the lows, okay, we saw that test down here. All right, the loss of an area and a retest. Okay, the loss of this, highest probability trade. Okay, gaining this, potentially a reversal. But the areas that I'm not concerned with are these areas. So see how you have these areas that line up with support and resistance, or areas where price is interacting with. Less concerned, not really trying to trade this unless you're talking about like trading on the 5-minute time frame. But weekly, daily, that influences the overall interaction between the lower time frames. Does anyone have any questions? I'm going to try to wrap this up, and then I'm going to try to follow up with all of the point is I'm going to start releasing all of the rest of the order flow videos. I've been releasing about one every few days, or two the last few days, and then you'll be able to know, okay, when I'm mapping out market structure. So when I'm looking at this, all right, clearly I know what's obvious. It's the swing highs, the swing lows. Okay, what else is really important? I put it on the Clark indicator. It's the monthly opens, and that's because your higher time frame participants are going to be looking to put positions on over a period of long time, and likely at monthly opens. Those are going to be areas that are again acted on discretionarily and programmed. Okay, turning this off. All right, let's see if the Clark indicator. Okay, that's just adding as confluence to any type of confidence to ultimately being some type of confirmation to evidence you already see. Let's see more questions. Or so yes, the first thing you do is obviously I define the higher time frame trend. What direction is the energy moving in? Okay, where are traders going to be caught off sides within these structures? All right, so any type of longs that are caught off sides, they're going to represent any type of selling fuel, or rather they're going to represent selling fuel. When longs over here are caught off sides, okay, that's why you get these backside retests. So this backside right now is because longs of this, okay, people who were longing this successfully the entire time, long, when it fails, when it moves up, they're sellers now, all right? They're sellers because at this point, when they're coming back to break even, they just want to be out of their position. They're not assuming the price is going to come up. That's not the thing they're thinking about. They're thinking about getting this position back to zero and getting out of the trade. So they sell. All right. Same can be said with longs. Your shorts that are off sides, keeping in mind when you're looking at a range, price moves above a range, shorts are off sides. The first retest, the reason why these backside and topside retests are so useful is because the shorts have to buy back in also, and it creates that forward moving momentum. What are your thoughts about moving stops break even as a means of taking off risk? So, great question. Terrible practice. So here's the thing. When you're looking at a trade, you already have in mind your plan. Worst case scenario, best case scenario, highest probability occurrence, what is the overall trend? Do I think that the energy is down, up? What side do I want to be on? Am I going to try to fade the trend? Am I going to try to go with the trend? All right, so that being said, you're also defining what is your area that is the invalidation of that trend. So if I say that, say for example, price is moving up in a range like this. All right, it's doing this. It's it's not moving up in a range. I'll take out the drawing board for this one. So say that price is moving like this. It's making a series of higher lows, stalls for a bit, gives us an opportunity to enter in. Okay, so it's consolidating a little bit. Okay, now this consolidation is great because it allows us to clearly define our risk. All right, so if we're currently looking to long, all right, maybe we're longing a breakout, you know, talk about volume coming in, looking at a footprint chart, seeing all that volume come in, seeing it supported by delta. So price comes above here. All right, your invalidation for that trade, okay, is based on market structure. It's based on the previous low. So your stop, let's say, was right here. Okay, so that is placed there because on the off chance that price comes up, consolidates within here, if price moves up here and then it moves back down here, it's not really a long anymore. All right, clearly, if under the assumption that if price is supposed to go up here, it should not be back down here. All right, and if it is, get out of the trade. You could reassess at a better point. But if price is supposed to go this way, it shouldn't be down here, right? It should have this continuation upward. So when you're entered into the trade, it doesn't take away that invalidation point. So moving the stop to break even, what it does is it stops you out of trades prematurely that you still should be in, because you already said before the trade was placed that, back up, you already said that this, all right, was neutral ground. You already said that it's fine for price to be here. As a matter of fact, it could have been there multiple times over. It could have continued to paint this range, all right? And you still said that was fine because you said that for the purpose of this range, if it is continuation, all it has to do is maintain these lows. And that makes sense. It's structure. So if you have a breakout and then you say, well, now I want to be out here, that doesn't make any sense because there are many times when price can break out, break down below again, retest, break back up. It could do a lot of things that are considered noisy, and especially if the liquidity is low enough, you could have a wick, you could have someone testing the depth of the order book, and you could be taken out incorrectly. Whereas nothing really changed with your original thesis, because your original thesis was that your short would have been invalidated or your long would have been invalidated if price came down here, not here. So you're not going to change your thesis mid-trade. You're only going to change your thesis mid-trade if something drastically changes with actual price behavior. So if, say for example, you see that price is, just paint this, making a series, it's ranging after a period of trending, okay, and let's say that we are placing a long, all right, breakout long, we're entered into the trade, okay, if we immediately start consolidating here, all right, immediately start consolidating here and then break down, okay, that's different, because at that point, our stop is here, but that was on the assumption or the presumption that price is going to continue upward, all right? But if price stalls here and it's rejected and we see it fall back down below, what we've done is you just created another point of market structure. So now you not only have this resistance, you have this resistance. So if you fall back down below here, you just created this resistance, and then your entry for this trade is no longer, it's suboptimal. Right? Your risk reward from here, let's say it was, to here is no longer the case. Now it's here to this structure, okay, and your stop is here. At that point, yeah, get out of the trade. Any other questions? So moving stops to break even. The problem with them is the same problem, okay, as putting tight stops on trending markets. Okay, so tight stop, trending market, the market has, let's say that we are entered in the market. So let's say, for example, we're looking to enter in a trending period. So trending period, what we're going to do, okay, we have a breakout zone of the previous area, fib to the high. Again, where does it line up with? The 382. So optimal area, 382.5, enter in here with limit orders, staggered, all at once, whatever you want to do. Enter in. Okay, at this point, get rid of this. One sec. If price is moving up like this, okay, we have our entry here, all right. It's a trend though, okay. It could have a lot of, you could see that this point right here, a lot of movement here. The average true range is pretty high. This movement here, okay, high true range. At any point, price can do a lot of things that are considered normal, meaning it could come up here, it could do this, 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 this. And it doesn't necessarily invalidate the fact that the trend could still be up. It could just spend a lot of time doing its thing. All right, and if you move your stop to break even at any point, okay, then you're going to stop yourself out prematurely. If you place a market in a trending or a stop in a trending market, so you have this pullback to the 382 fib, you have your entry, and then you place your stop at this area, you can be stopped out right away. So, for example, say you got in, say you considered that this was the pullback. Okay, when price came back down here, your structural stop was taken out, even though it just took your liquidity and moved up. So what you need to do in a trend is look at something like the ATR. So average true range, so ATR. Okay, so now we have the ATR. So for this period up here, you can see that the ATR is $286, $280 to $250. Say that's what it is. Okay, it goes from 150 to about 280 from that point, 300 at the top. So let's just say 280. That means that the ATR, the average true range, or what is considered normal price movement for a daily range, all right, for this period setting, 12-hour daily, whatever you're looking at, is within that amount. Okay, so that means that if price moves $150, it's just par for the course. There's no reason to think anything's weird because that's been the average, right? The only thing you want to pay attention to is things that are outside of the average, or considered things that are outside of the normal standard deviation of what is considered outside of the normal standard deviation. So 1.5 or 1.1 to 2 times, 3 times the normal standard deviation. But in this case, we're talking about multiples. So instead of looking at the ATR and saying I'm going to give it, a stop that is, let's say, say the ATR is, say we're in a trending market right now. We entered in, and let's say we enter in at this breakout. The ATR is specifically $250. Okay, we're not just going to put a stop $250 away, because at that point, price can move back down and be considered normal. Okay, it'd be considered within the ATR. What you do is take a multiple of the ATR. So say it's 1.5 or 2 or 3. Mind you that when you have a larger stop, you have to take a smaller position. Okay, so a larger stop implies more distance from your entry. So if your initial risk is, say you're risking 2% of your capital, or let's say 1%, all right, your stop might be, in this case, all the way back here. If we're looking at this, let's say our stop is $200 away. That stop would be your $250, right? So that stop would be just around 4%. So you'd have to take a quarter of the position size you normally would. But that wouldn't be the proper stop, right? Because at that point, and this is why you end up scaling into things. At that point, since the ATR is 250, and this is an actual trend that is occurring and needs room to breathe, your stop can be based on, let's say, 1.2 or 1.5, and you take the ATR and you multiply it by that multiple, whether it's 1.1 to 2, and let's say it's 1.1. If the ATR was 200, then your stop at that point would be $300 away. So it'd be let's say it's 1.5. Okay, so it would be $300 distance away. And what that means is, since the ATR is 200, if price moved 300, all right, that would be considered abnormal. But if it moved 250 or 220, that would be considered, just a little bit of noise, right? You don't want to be stopped out prematurely. So in a trending market, your best bet is to use some type of trailing stop, smaller positions to begin with, and then scale in. So what happens, you're going to put on that smaller position size, and then you're going to be scaling in at pullbacks. That's why people say buy dips and trends, because you're not going to buy all at once. You can't. You can't put on the proper amount of a position if you're dealing with a limited amount of capital and you're trying to preserve it. You have to buy these pullbacks, okay, pullback, 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 right, and add on the way up. All right, so in a major trend, you add on the way up, and each one of these is going to have the proper risk setup or proper stop placement based on the current trend or current levels of volatility. So it's a volatility stop. You can actually just use volatility stop, and I have mine set 2. So what that means is it's a multiple of 2. At any point, these lines are going to be considered normal. So if I go into the daily right now, and you can see how perfect this was for the daily, if you used a multiple of 2 of the ATR, so going on, putting on this line, you can see that if you used a multiple of 2 for the entire trend, you're only out once, twice. Okay, so here shortly entered in back down here, but still you could see that majority of the trend was captured in terms of the impulsive moves up, and you weren't taken out on the slight pullbacks that occurred within it. So if you looked at it on the daily, you exited on the daily as well. So any questions? We're going to finish up. All right. some feedback would be good so that I could set up another session and we could touch on things that maybe you feel like you need to learn more of. Okay, thanks for saying it's a great session. So all of the stuff that we release on order flow, it's going to be to assist you in being able to determine when we're identifying, certain areas of market structure, what is going on at that area. Okay, who is in control? So we obviously know on the higher time frame always who is in control, but learning order flow is also going to help you trade the lower time frames a little bit better. So order flow traders are great scalpers, okay, because they can see within what part of the auction, buyers in control or sellers in control, where buyers are losing control. All right, but the first thing you have to do is be able to identify where it is best for you to enter, period. So that's why it's really important to be able to answer questions like, what is the trend, right? Where do we sit in relation to the higher time frame trend? Who is in control, right? Where are traders potentially offsides? How can we take advantage of that? So when you see trap traders, it's no longer that they're just trap traders, it's that this is an opportunity to, when you notice trap traders, okay, let's say you see a ton of volume up here, but a close below here, to get on the opposite side of this trade, all right? And what that looks like is, again, the highs, it always is going to look like this, all right? Trap traders up here, price moves down, they have pressure now to get out, so the retest of the high is the highest opportunity to trade to take at this point because the trend is down, all right? The lows are not the higher probability trade to take because they are going against the higher time frame trend. So just consider it like waves going against the tide. All right, guys. If that's it, let me know if you have any questions and send them over to Block-Roots. Hope everyone has picked up a good amount from this. There's a lot of stuff to still always go over. But yeah, have a fantastic night, guys. And as always, it's been a pleasure. Thanks a lot, guys.